side of the order. So it's and sort of in that avoidance, right?
No, and here's the thing.
Yeah, go ahead, Alex.
I was just going to say, this is exactly what Citadel's brief is designed to do, is to draw you down into actually making an argument about the merits of the things that the SEC is considered. That is not this case, right? It's not ultimately for the judges or anyone else to decide. And it is fascinating, Dave. I didn't mean to cut you off in that regard. The briefs do, really reveal a lot about the thinking, or at least the way that they're trying to position themselves, both Citadel in terms of narrative and the SEC in terms of, draw you down with which they're trying to knock each one of these down. But if you read the two briefs, what you'll see, and you have, but if people do, they'll see Citadel really tries to drag people down into the details of the correctness of the SEC's conclusions. And that's not what this is. And that's why I think, as Dave was alluding to as well, it's the standard of review is so high. The SEC just needed to consider these things. Citadel is trying to argue that the SEC's consideration was wrong. A party can't substitute their own judgment for an agency just because they don't like the determination of the agency. So today, in argument, what I would expect is for Citadel's attorneys to try and draw the judges into this was it correct? Was the outcome and conclusion correct? Because that's not what it is. It's really, did it even occur? Did the analysis occur? So I just wanted to...
Yeah, and that's been eye-opening to me. Like, I didn't realize that going into this, especially as I read the briefs. And I mean, all I'm going to do is get sucked into the market structure argument. I'm not a lawyer, but, that's how I see things. And so, from my perspective, that was the argument that seemed to be, consistent throughout, and it was consistent throughout the supporting briefs as well. So it was even there with like another major high frequency firm, XTX, filing a supporting brief and talking about latency arbitrage and talking about the cost of latency arbitrage. I mean, that's obviously what I want to talk about, and I think it's a fascinating topic. But at the same time, we can also get into this idea. I think people should make sure to understand that this is not an isolated thing on Citadel's behalf. I don't know how many people are sort of familiar with the history here, but Citadel was aggressively opposed to IEX becoming an exchange. They filed 5 papers, and one of them was about how IEX would harm retail investors. And they were a big participant on IEX. That's kind of questionable in itself, certainly at present. And so, I think Citadel has fought IEX every step of the way. And whether that's because IEX does a good job of fighting latency arbitrage, as they claim, and Citadel is harmed by that, that's one possible explanation. I'm not endorsing that. I don't know that that's the case. I can't take a stance on what Citadel is doing and why and how they're making money, but they do seem to fight IEX every chance they get. And for something like this, it seems like they're more interested in delaying things as much as they can. And I think there are ways to look at this that are kind of surprising, but you have to think about it even from a market maker's perspective. If what IEX is doing will actually work, as IEX, the SEC, and another, a bunch of other firms believe, and it leads to tighter spreads, that's not actually a great thing for a market maker, right? Market maker doesn't want tight spreads; they want wide spreads. They make more money that way. So there's some kind of perverse incentives, I think, at work here as well.
Yeah, and those are really great points, Dave. And I just want to go back on one thing that I was thinking about, and also read something directly from one of the Amici, because it's just a really great line about Citadel. But when I look at this case and I think back to it, remember, this was all going on way before January even happened, right? This was before Citadel was even on, a lot of, retail investors' radars, right? We weren't all thinking about Citadel and what they may or may not have been up to. And it's so interesting to see, that they made these arguments and they sort of opened the door to the Amici to bring up points about them, about Citadel in general, calling them predatory. And I mean, abstractly, yes, were people aware of hedge funds and the fact that they were predatory? Yes, but not so specific as I think many people are aware today. And I think it opened the door and allowed, colorful language like this, which I really love in this brief from Healthy Markets. Citadel Securities undoubtedly excels at what it does, but it takes a breathtaking amount of chutzpah to claim that you speak on behalf of your direct counterparty in a zero-sum game. In other words, when Citadel Securities claims it is acting only on behalf of retail investors, it has all the gravitas of Sylvester the cat claiming innocence while Tweety's tail feathers are hanging out of his mouth. I mean, that's a great line, and I just love that image of it. I'm surprised no one's created a meme with it.
That needs to be a T-shirt.
Exactly.
Do you think that the veil of better execution quality is kind of being used as a Trojan horse for the byproducts of what is required for that execution quality? In particular, being that lack of latency to perform high-frequency trading. The actual position of being so close to that latency does, in theory, provide better execution quality, but the other byproducts of that can lead to disadvantages for other members that are trying to create liquidity for markets. Is that fair to say, do you think?
So I think, yes, I think it's a disingenuous argument to say that something like this will result in inferior execution quality for retail investors, given that the way the order type is structured is explicitly to protect firms who cannot compete on speed with the fastest firms out there, right? If you remember, Ken Griffin said in a recent interview that, it's still the fastest firm wins. That means everyone else is losing, right? And that loss is an execution quality loss. It means that, for example, you immediately get into a position where the price has moved against you. That's something called adverse selection. And it's a little complicated to get into, but that's sort of at a high level. It means that you're already at a loss immediately as you're in this trade, and that's a byproduct of latency arbitrage. And as I think I liked what XTX said at the beginning of their brief, that latency arbitrage can produce a series of costly consequences: less displayed liquidity, wider bid-ask spreads, and greater price volatility.
And you also get concentration within that, which when you have as diverse of a market that we have nowadays and the types of liquidity pairings that are generated, it does seem rather dangerous to have so much concentration residing in one market maker's capacity, if that makes sense, that you have somebody who not only is receiving a very large amount of what's going on, but the speed at which that they're able to access all that and also generate as far as liquidity goes, you only can have one winner at that degree when you're varying between nanoseconds at a time. To have somebody who is so on the ball with it, in theory, yeah, it's a great thing, but the concentration that results of that, you're basically setting a cascading ripple-esque effect if everybody else is generating their quotes or other pieces of liquidity from that one person who is at the front of the line.
I mean, I definitely think, concentration is a huge issue. It's something that Gensler has pointed out a bunch of times now, and I think it's a good basis for which to have the SEC, start to look at these things, because it's very dangerous. It leads to less diversity, as you're saying, right? It leads to less market making diversity, and it's a real problem because that makes markets more fragile. That makes execution quality worse and market quality worse. That widens spreads when you start to concentrate huge portions of trading into one or two internalizers who are also the largest on-exchange market makers and who also have a speed advantage over everybody else. That's a serious problem for markets.
Right.
And I want to underscore the importance of the SEC statements that the IEX had submitted substantial evidence around the existence of latency arbitrage occurring on the IEX exchange, and how Dlimit would address those specific instances, though minor in time, relatively material in overall impact. The fact that the SEC looked at it, made a considered determination, and concluded that the Dlimit would help address latency arbitrage is itself enough to overcome the burden of showing that this is arbitrary and capricious. So the discussion that you folks are having, which is reflected in the briefs to a certain degree, is itself the evidence that is required. The fact that 2/3 of the public comment during the notice and comment period were in favor of the Dlimit shows that reasonable minds can differ on the import of each element of evidence being submitted. So all of these things, this conversation, its existence in the briefs, the extra brief materials in terms of note and comment, these are the things that the judges are going to be looking at. And I think based upon what I'm seeing, these conversations, it should be a relatively straightforward determination.
Just a quick update, guys. I'm watching the stream right now. The judges haven't taken the bench yet, but I will note that the stream usually, I'm looking at the last couple of oral arguments for the court. They usually get about between 200 and 1,000 views. Right now, there's about 3,200 people watching.
Now, do we think that's because, so many people support the idea that Citadel is for retail and they want to just come support Citadel?
It must be.
Must be.
It actually underscores what has been so amazing to me over the last few months is just suddenly how many people care about market structure. And this is, you couldn't get more into the weeds than something like this. And an algorithmic order type that counteracts the cost of latency arbitrage, right? And yet, look how many people are here on the stream and listening into the court case. I just think that's so good. It's good for markets that people care and that people are interested, and I think it'll lead long term to some better outcomes.
And the awareness will not go back in the box, that's for sure.
Yeah, I think it's probably worth mentioning, because we call out firms when they don't do things that we don't like, and it's probably worth pointing out that Virtu filed a comment letter supporting the Dlimit order type, and in so much as Citadel will ever make a case that they represent retail, regardless of how true or false that is, Virtu will certainly be able to make the exact same case, and they generally support changes and innovations in markets, and I think it's just worth pointing out that a similarly situated firm does not see the same problems, and I think it's interesting to wonder why, but I think it's a good thing to note.
And if ever there was needed evidence that there could be a reasonable differing interpretation of the impact of these rules, it's that. The two largest market makers having different interpretations, different positions, both presumably inherently reasonable. All the SEC is required to have its own reasonable conclusion, which aligns with 2/3 of the comments, including Virtu's. And again, that's why I think this is a relatively straightforward case for the judges.
So somebody just messaged me if we can kind of go over IEX's role. Lots of apes are confused. This topic seems to be Dlimits were made by the SEC. Somebody wants to just clarify that.
Yeah, I can talk about that. So IEX, just take a full step back. IEX is a stock exchange. They're an approved stock exchange in the U.S. And have been for several years. A firm that I've worked with in the past and have supported from the beginning because I believed in what they were doing. And exchanges compete against one another. It's very weird. The whole market structure around exchanges in the U.S. is very weird and confusing and complicated. So I don't blame someone for being complicated. Exchanges are what are called self-regulatory organizations. It's the only industry in which for-profit companies are also self-regulatory. So take that as you will. But what self-regulatory means is that it means that there is a part of each of these companies that is quasi-governmental. They're an extension of the regulator. And as such, they sort of get some deference from the regulator, and they get to do things that they file. They can file things that are sort of immediately effective versus ones that the regulator actually has to approve. So that's an important distinction in understanding how an exchange designs and sets its rules. And the exchange has control over a whole lot of rules, and these rules set how the exchange works. It varies from fee structure, how much do you pay to trade, or how much do you pay to, or how much do you get rebated, all the way to order types and matching systems and order routing, because exchanges have to route their orders out when there's a better price on a different exchange, to market data feeds. There's a whole lot there that an exchange has to account for and build and design into their rule book. When they make changes to their rules, those changes are filed with the SEC, and those are called SRO filings, the Self-Regulatory Organization filings. So an order type that IEX comes up with is filed as an SRO filing with the SEC. It's important enough that it's not, I guess I'd have to double check. I wouldn't have thought it's immediately effective, so it's something the SEC has to approve, versus traditionally, for example, fee structure changes have been considered immediately effective. That is actually starting to be challenged pretty effectively too. But small changes can be considered immediately effective. Large changes, like a new feature, a new order type, has to be approved by the regulator. I do think it's important to kind of point out here that given latency considerations and market complexity and the sort of perverse incentives at work in the maker-taker fee structure, and the latency race to zero, generally exchanges are innovating in ways that are focused on fee structure and speed. And that is true sort of universally. It doesn't mean other things don't happen, but it means, generally speaking, most innovation in the exchange space is focused on adding complexity or reducing speed. And IEX generally has been pushing in the other direction, which is that they are innovating in different ways. They are coming up with novel order types. They are putting a speed bump in place. They're not paying rebates. They don't have complex fee structures. They don't charge for market data. Every single thing that I just listed there is really, completely different from other exchanges. And it's generally a question of incentives, where IEX is not publicly traded and has been funded mostly by asset managers. Of the other exchanges are publicly traded for the most part, and generally focused on their biggest customers, which are the high frequency trading firms who do the most trading and therefore generate the most revenue for them. I guess that explanation was so shocking that everybody had to take a moment.
Yeah, I'm still collecting myself after that one.
I think the nature of these is there's so much information in this that it's like, as people hear it, it's digesting. It's not, we're not reading Sun Tzu, The Art of War. We got to read the same sentence 42 times, but there's a lot of information out here.
So I guess if you had to condense this into one, like a TLDR kind of, a too long didn't read, what would you say is being argued today? What's the one-liner for this, and why does it matter?
I think in terms of the court argument, it's, I think as Alex has said, this is really going to be, did the SEC do its homework? And, it's hard for me to see that the answer is no. I agree with him. It seems like a slam dunk. I do think that Citadel will try to change that subject, because that's not a winning argument for them. And they'll try to say, but look, we represent the retail investor, and this will damage retail investors. And they'll try to appeal in that way to, all sorts of different sentiments maybe that the judges might hold. But, in reality, it's probably more of just a delay tactic than anything else. And don't forget this, there's sort of a massive conflict of interest underlying all of this, which is that Citadel and Virtu recently funded the new Memex stock exchange. And, so they have funded a new stock exchange. They are, responsible for all this order flow. They try and, maintain the status quo of payment for order flow. But if it all falls apart, they're sort of ready with the stock exchange, and so, if they don't like something on another stock exchange, there's certainly a conflict there. It doesn't mean exchanges don't fight each other for changes or to prevent changes, but it's not. I don't think it's something a lot of people are talking about right now either.
There's like a market within the market, which isn't so outlandish to think of if you're from within the realms of what's being talked about within this contention. But the structuring of fees and the structuring of rebates all are this own living, breathing system that exchanges and different broker-dealers and other just market-making entities all are adapting to based on those structures of fees and rebates. Is that fair to say?
Oh, yeah. I mean, the fee structure complexity is really absurd. And, it was so absurd at one point that the SEC didn't even know what it was when they were trying to structure the transaction fee pilot. And they started to come up with, rules that these structures had to be disclosed in a machine-readable way so that they could have a computer try and figure it out because they couldn't figure out the complexity. And there's massive conflicts of interest baked into exchange fee structures. I mean, that's just, it's hurdles all the way down on Wall Street. It's just conflicts of interest all the way down. So the exchanges use fee tiering to reward firms that send more order flow to that exchange, which perverts order routing practices and makes brokers route not necessarily for execution quality, but for fee minimization or rebate maximization. I mean, it's and there's no no best execution enforcement because, as FINRA has said in the past, trying to enforce best execution is like trying to staple Jello to a wall. So everything is all conflicts all the way down.
Right. Are you familiar with the NYSE retail liquidity program?
Yeah, I mean, I read about it when they were implementing it. I was reading the SRO filing.
Yeah, I've done some digging into it, and I have to double check what the required threshold is to be a member of that program, but I think it's only 10% of the day has to fall within those execution parameters to be a member of that program. And then, of course, you have an asymmetric distribution between the requirements and the actual benefits that reward big players. But that alone, when you start to see all of these finer and finer lines being created within exchange fee and rebate structures, it just really details how messy this thing is. And I think that now that you have light being shed on it, there's going to be a lot of revelations that occur that are going to reveal some of the strengths of our markets, but also the quiet but ever so disastrous vulnerabilities of it. Especially when you have, internalizers that are reporting, I won't name any specific tickers, but some of them have 10x the float being executed within internalizers in one day. How does that make sense for anybody but the entity that is performing those executions?
Yeah, I mean, I think those kinds of stats, when you see like multiples of the float being turned over in a day, call a lot of things into question in terms of what the underlying mechanics are that are going on.
Right. And then also just the monetary incentive for performing that egregious amount of just back and forth just for the sake of going back and forth. If you look back at 2008, one of the major cruxes to the downfall of the global economy was, yes, the liquidity of everything that was being traded, and of course you had some financial instruments that were just inherently footholds for themselves, but it was the quality of the liquidity. And when you have liquidity just being moved around for the sake of moving liquidity around instead of prioritizing the quality of it, that's kind of like the preface to what can create disaster within markets.
I agree. I think this is a really important point that we're losing diversity in markets when you have concentration like this, and it leads to fragility. It also leads to arbitrage of liquidity. And
that's a good word for it.
Yeah, there was a good story. Someone was in a meeting with an exchange executive, and they said, "Look, I think we all need to agree and understand that volume does not equal liquidity." And the head of this exchange just started cracking up, laughing, and called the guy straight up to his face an idiot. And he said that's absurd. And yet, you can look at the flash crash as one of the highest volume events in all of markets, and also one of the least liquid.
But there was so much volume.
Right.
There was so much volume, though. It had to be good.
So
our markets are strong. Stronger than ever.
Yeah, I mean, there are incentives to churn in markets, and that churn makes it seem like there's a lot of liquidity, but when you need it the most, you tend to not have it.
Kind of reminds me of like a liquidity filibuster, where you're just kind of moving stuff around just to move it around, such that you're meeting all the marks, but when you actually open up that Pandora's box, you look inside of it, and it's a nightmare. I feel like there's too much liquidity within markets, and I think a lot of anybody who's more understanding of this or at the same level of, as far as market structure and the way that these mechanics all interact with each other goes, they might laugh at me for saying that, but I truly believe there's too much liquidity, because you look at just how much can be moved around in the pairings that are generated with it. Like, we just had a Bitcoin ETF go up, and you've created a direct connection between the crypto market and now the equities market. And then you begin to wonder, well, we know how volatile crypto can be. And I love crypto personally, but just for the sake of argument, let's just consider how much of a wild west it can be when you have different tokens and different coins that are all kind of just moving around. When you start interconnecting these particular coins and tokens to things like Bitcoin, if you have enough influence between that pairing, eventually, if you have too many lack of quality connections like that with Bitcoin, well, now you have a direct exposure from the crypto market, but then the equities market. And then if you have a particular player, whether it's a big fund or a market maker who has too much weighting within that particular ETF, if for some reason there's a coin that is able to bring Bitcoin down with it, or the other way around, where now that any liquidity pairings that have been generated off of that basis start to tank, well, now you have these players that do have the ability to make markets move who are now suffering because of that. It's a type of vulnerability that I think not many people have parsed and really considered. And I think a lot of it has to do with the way that you have, again, concentration of particular market makers and participants, and the way that they interact with the markets.
I mean, I'm a huge fan of cryptocurrencies. I have been for a very long time. But I think it's insane that the SEC approved that Bitcoin ETF. I think it's insane only in so much as the reasons that they've been denying ETFs have not changed. Like, there's just because it's a futures contract doesn't mean that the underlying market is a regulated market and subject to the standards of surveillance that they require. So I think that was absurd, and now there is no argument for them to make that they shouldn't just approve every Bitcoin ETF that's ever been approved.
Right.
All right, guys. So sorry, guys. Get out.
No, please go ahead. I was just going to continue the conversation. Please go ahead.
Yeah, no, I was just asking Dave a question about something that's in the brief. I wanted his opinion on something about what Citadel said. They make this statement. They draw this analogy. They say, to put it in practical terms, imagine a grocery store that has deliberately installed extra long conveyor belts on checkout lines. After you've committed to buy your items at the advertised price by placing them on the belt, the store uses the extra time required to traverse the belt to determine whether any item that was available at the same price that competitor stores have sold out. If so, the store's computers quickly raise its own price before your item reaches the cashier. You can either pay the higher price, etc. So, Dave,
it's so ridiculous. It's such a ridiculous metaphor. As I was reading through the brief, that was like one of my first notes. Citadel opens brief with a really terrible metaphor about grocery stores.
It reminds me of that scene from the interview where they finally go to the supermarket and they realize it's all just plastic fruit.
Right. I don't even know where to start with it. It's just completely backwards, right? So it's like, okay, I'm going to buy something, right? And I don't know. I don't even know how to like translate the
It's like being in the line
into this metaphor. I mean, like, it's like, first of all, you're talking about a grocery store where this would only happen like 3 seconds a day. Okay, so first of all, that's what we're talking about. You're trying to tell me this is a material thing when it's only active 3 seconds in a day. It's not like, this is going to happen half the day. And then second of all, you're talking about like the most minuscule repricing of something just because that's the actual price. See, that's the funniest thing about this, is that they're fighting something. They're fighting this order type that is doing its best to reflect the actual price. The price that the order was at before the crumbling quote indicator fires was the right price at that time. But once that indicator fires, it means that it's not the right price anymore. Right? Like, that's the thing. And it doesn't happen hardly at all. But for those couple of seconds a day that it happens, it's an exchange fulfilling its responsibility to make sure that it has a better view of this very complex set of market feeds than the fastest people who are interacting on the exchange. And
just to clarify,
yeah.
I'm sorry to cut you off. When you say a couple seconds a day, that's collectively throughout all of the HFT. You're right. It sums up to being seconds a day because they're actually executing at such fractions of seconds.
Right. It only fires for a 2 millisecond period at most. Right. So that's what we're talking about.
So all of this then, which all then begs the question, though, right? So let's make a few basic assumptions, and then we can go off into a fun land of supposition and speculation. So Citadel knows all this. Everything we're discussing, they know. Their lawyers are good lawyers. I wouldn't say that they're Citadel's most expensive lawyers, but they're probably Citadel's second to third most expensive lawyers, right? They're aware of the standard of review. They're aware of the likelihood of prevailing on the arguments of the case. So then let's peel it back another layer and look at what could then the potential outcome, desired outcome, be. If this is a Hail Mary case to begin with, it's going to cost millions of dollars to litigate. So far, it's been in the courts for a year to 18 months. Before this case is over, it will be in the courts, in all likelihood, if there's appeals, for, let's say, conservatively another 6 months. So we'll have a 2-year arc of a case that was a long shot to begin with. So the question becomes, why? It could simply be, and this is what they would point to and their attorneys would point to, is that this is worth pursuing. That a remote chance of prevailing doesn't mean that there's no chance of prevailing, and we're going to exercise what rights we can to protect retail's interests, apparently. But let's put a pin in that and maybe just look at some of the other outcomes, other implications of the conduct and what resources the case itself, just the conduct of the litigation, are consuming. So in terms of resource consumption, obviously it's taking Citadel some cash. For an appellate case like this, $1 million to $2 million to this level, for this level of lawyers, would be a reasonable expense. But when you're measuring profits in microseconds, and we're talking about an 18-month case, what's the value of that? So you have a minimal expense on a petitioner's side relative to their war chest. You have, on the other side, SEC resources that then need to be designated to prepare, research, argue this case. So there's a team of at least 3 on the brief that are 3 of a team of total, maybe 100, 150. So right there, you're having an impact on the number of bodies, the numbers of brains that can look at anything on the market-wide, let alone a specific issue that might be another issue that you want to address. And then thirdly, you have intervener, IEX, who arguably doesn't have to join the case. They're an intervener. They chose to join the case, but their rights would be materially impaired had they not. So this is imposing an expense on IEX as well. So by just engaging in this process, in the litigation process, there's already result out of it. And it's something to always consider, because litigation is a practice. Litigation is a tool, especially at a certain level, just like the law. And, there always obviously has to be a colorable and defensible argument to be made. You cannot abuse the court system. That is a very serious thing. But that doesn't mean there can't be multiple motivations simultaneously that are undergoing. And I think with the low likelihood of prevailing here, it's worth exploring.
Yeah, I struggle to see it. Like, I would have thought maybe just a delay tactic, but it's not like they're delaying the implementation of it. So I don't know. Maybe it's a crapshoot on the off chance that they get lucky. Where they're able to convince a couple of judges to prevent the implementation, or they go back on it while it winds its way through the court. I don't know. It's a good question. Maybe they just want to maintain consistency of fighting everything IEX does, what they've done from the beginning.
So Dave, what are the in real world terms, what are the implications of this, order being implemented fully? When it's fully implemented, what will the real world implication be?
Well, it's implemented. I mean, it was approved.
So how is it affecting markets? So if it got reversed, maybe that's a better
right. It provides functionality. I think here the overall thing is it provides this really unique functionality. Like I said in my Reddit post, it looks a lot like a high frequency, like the equation that would underlie a high frequency trading strategy. And so it provides this functionality for investors or market makers that they don't need to be as fast as the fastest firms, because they can rely on an exchange to protect them and protect their order against this, immediate adverse selection. Now, a big part of the problem with IEX is that their fee structure is fundamentally different from every other exchange. So every other exchange will pay you to trade there, either as a liquidity provider or a liquidity taker. So liquidity provider payments and rebates that's called a maker-taker exchange, and liquidity taker, if there's a rebate for being a liquidity taker, that's called an inverted or a taker-maker exchange. So every other exchange has decided that they will attract order flow using rebates, which is very similar to payment for order flow. The IEX has said, we're not going to do that. We're going to charge both sides of the trade equally. It's going to be a low fee. For retail, we're not even going to charge retail. It's free for retail to trade on IEX. And not only is it free, but often you're going to get a midpoint execution. And if you don't, you can rest your order and it will be protected against adverse selection. So that provides a really strong argument from a best execution perspective, that if firms really did value execution quality, they would be taking advantage of these features. And that's the kind of thing that other firms are not happy about, because they're happy in a system that I always call good enough execution, not best execution. And so that's, I think, sort of underlying all of this and underlying all of the resistance to IEX is that IEX represents a facility for getting better execution than what a lot of firms are calling best execution, and it exposes what they're doing as being good enough and not really best. And that could be a big problem from an enforcement perspective, a regulatory enforcement perspective. These market makers have really worked hard to not post orders on IEX and to keep IEX's market share low. And so that's the other side of this, is that IEX is a very small part of U.S. markets, and so there are all sorts of things you could start to think about as to why that is, that sort of have nothing to do with fulfilling one's best execution responsibilities.
Thanks, Dave. I appreciate that.
Sure.
So as usual, the courts, justice is slow, and they're really slow this morning. They're about 30 minutes behind, it looks like, for taking the bench. The stream is up, but there's nobody yet in the courthouse. So apologies for that, but obviously that's beyond our control. So at this point, if anybody would like to ask any questions, I was going to save them for the end, but since we have some time, if anybody has some questions for anybody on the panel, send us the questions via DM, and we'll address them in turn.
Absolutely.
I'm sure. I'm sorry, Dave, is that okay?
Yeah, it's a great idea. And in other words, in the meantime, might as well, we were going to do like QA at the end. If you want to just DM some questions in to anybody on the panel, we'll just read them out and kind of go over them. We're happy to do so. I just ask everybody just to kind of keep an eye on their inbox. I had two questions, but we kind of already answered them. So just DM any questions you have for us, and we'll get them out there. Utilizing the neural network to find information wherever it can be found.
All right, so I got a bunch of questions. I have like 10 in my inbox. So I'll just go over them one at a time. Ape with Armstrong asked, what would be considered best execution? Better price or faster trade?
Sorry, my phone didn't want to unlock there. Okay, so best execution is a pretty interesting principle in markets. I've spent a lot of time with institutions on best execution. So from an institutional perspective, like a pension plan and mutual fund perspective, and from a broker perspective, basically, best execution is kind of how you define it. It's not a prescriptive standard that regulators have set out. All that regulators have said is that you need to be doing regular and rigorous review of execution quality and of your policies and procedures and your order routing practices. And so from that perspective, and this is why I said earlier that the regulators have really struggled to enforce it, because one, you need a quantitative level of sophistication to actually show that there is damage occurring, which regulators struggle to do. And because a firm can say, well, all we care about is speed of execution. We don't care about price. Or all we care about is size. We don't care about price. So from an institutional perspective, it's a very difficult thing. From a retail perspective, though, I would say best execution is a bit simpler because retail orders are small. and so they're generally immediately executable, which is the difference from institutions. So institutions are large orders that are not necessarily immediately executable. So from a retail perspective, best execution would both be the ability to transact the size that you want, which is usually within the NBVO, so that's usually not difficult or a problem, at the price that you want or at the best possible price, while not being subject to adverse selection. And that's the other side of this, where there should be enforcement of best execution. We have not seen robust enforcement of best execution, especially where retail is concerned. And even if you think about the fine, when Citadel was fined $22 million a few years ago for what should have been a best execution fine and ended up just being a disclosure fine. So every time you've seen regulators act in the world of best execution, pretty much you've only seen them not actually act against the execution practices and quality, but simply the disclosure that Citadel was using a faster feed for their own internal trading, or picking the price, from the slow or the fast feed, depending on what was more beneficial for them. They were hit for that for $22 million for simply not disclosing it, not that they were actually doing that in practice. And then, the other side of it is we've been talking mostly I think retail thinks about things in terms of market orders and marketable orders, but of course the Dlimit is for non-marketable orders, it's for posted orders. And then from that perspective, there's sort of another standard, which is that brokers need to route based on execution quality and speed. And so there's a huge conflict here, as I was explaining earlier, in terms of fee structure. So, for example, and this was years ago, I think this was in the 2014 or 2015 hearing, where one of the people at TD Ameritrade was trying to explain to the Senate committee. I was at the hearing, and he was trying to explain to the Senate committee how they route orders, resting orders, the non-marketable orders. And he tried to make the case that they route based on execution quality. And then they looked at the actual numbers, and it showed that they were routing nearly every single order to direct edge X. And was it a surprise that they were doing that? Because at the time, direct edge X offered a bonus tier, which was a 35 mil rebate or something like that. I think it was a huge rebate. So going down the rat hole here, I know it's getting complicated. There's an access fee cap of 30 mils in markets. You can't charge a fee of more than 30 cents per 100 shares to take liquidity, but there's no such limit on rebates. And so Direct Edge was actually offering more in the rebate for posting liquidity than they could possibly collect from the other side of the trade that would be taking liquidity. So they were willing to lose money to entice resting retail order flow to their exchange. And the TD Ameritrade guy admitted that nearly all of their orders were being routed to Direct Edge X. When they offer that high rebate, it means that the lines at that price level are longer than any other exchange. So in fact, every retail order which was resting at those price levels was at the very back of the longest possible line, instead of being sent to something, for example, like an inverted stock exchange, where TD would have had to pay to execute the order, but it would have been far better execution quality for that retail order. And so that's sort of this fundamental conflict of interest at work with exchange fee structures and rebates, where brokers route based on fees and fee minimization because they make more money, versus route based on maximizing execution quality. So that's a long tirade on best execution. That was a dangerous question to ask.
I actually heard Pandora's box open when you started.
I tried to keep it quick too.
Hey guys, so I think we're going to be going live in a couple of minutes. So keep talking. I'm going to be focusing closely on listening right now. But as soon as it goes live, I'm just going to cut in. But continue the conversation until I cut in. Thanks.
So I've got a question. I had someone write in, and they were inquiring whether, obviously, what Citadel's motives are we're speculating, but whether it be a delay tactic or, finding a ruling in their favor, they're wondering if it only benefits Citadel or does it benefit, other market makers like Point72 as well. They cited them specifically. Obviously, this would be speculation, but they were interested in the panel's thoughts.
I'm not sure that, I think if you are engaged in latency arbitrage and this could damage that, profit center, and there's a chance to, avert that damage, then, you'll do it and you'll benefit if you can. And if others are engaged in that practice, then, yeah, sure, that, it could potentially benefit them. But, then again, on the other side of it, Virtu, which is one of the fastest firms out there too, and they don't seem to care, so I'm not sure is all I can say.
Fair enough. Thank you, sir.
Stop coming out. Stop coming out of the room.
No, I think on that point, just on the face of the briefs, it would benefit other similarly situated parties. IEX had identified 5 different proprietary trading firms who Citadel was one of the 5 in that bucket. They successfully, I suppose, argued their way out of that bucket, but the SEC ultimately redid their analysis even in the absence of Citadel's impact on IEX's evidence that they had submitted in furtherance of latency arbitrage. So in the most direct way, if Citadel wins, those other 4 proprietary trading firms would, reap the benefit in the wake of whatever positive conclusion, Citadel was able to achieve.
Someone sent me a question, and they're saying, how can retail place Dlimit orders? Right. The answer is you can't, first of all. That the orders can only be placed by brokers. So that's just to understand, orders can only be placed on exchanges by brokers. That's step 1. So step 2 is to get your broker to support that order type. Now, the problem is that nearly every broker sends almost all their order flow to Citadel and Virtu, who would certainly not support the order type because they don't generally route resting limit orders to IEX because, like I said before, if you execute a limit order on IEX that is a retail order, it's free. You don't have to pay. But if you execute that same order on a different exchange, that exchange will pay you. So regardless of whether that other exchange is protecting your order or not, your broker and the internalizers are incentivized to route to the exchange that will pay them instead of the exchange that protects you. So again, we're sort of back to this fundamental conflict of interest that's wrapped up in fee structures and all sorts of other perverse order routing incentives. You could attempt to get people together and convince a broker to support the routing of that order type, but you will be fighting a fight that is unlikely to be successful given these order routing incentives.
I think Fidelity may be working on it. I remember seeing on their subreddit a lot of people had been asking, and they said that they were looking into it. But so maybe that's the first retail broker that'll let us do it.
I'd like to believe that. I'd like to see it.
Yeah, I mean,
skeptical.
we'll see.
Yeah.
But the fact that they discussed it on a subreddit that they run, makes me somewhat hopeful.
If they said they're looking into it, then they probably have to be, because that's a pretty big misrepresentation otherwise.
Yeah, I'll see if I can find the post.
I got a long question here. SEC stated 134 ticker symbols had volatility during January. If you look DDS, it had the same trajectory as GME, but it was not FOMO, since GME had that uptick in $400 aftermarket when retail can't purchase. That has to be Melvin covering, right? Also, there are ETFs that have the tickers that had an uptick in January with FTDs in the 100K to 400K range. A lot of information in that one. Do you think that was Melvin covering, or do you think that was manipulation?
I have no
Question for anybody.
I have no idea personally.
Well, I think just some simple facts. I'm just going to state right now, this is completely my opinion. But the way January went down, and with how cutthroat you-know-who is, I find it so weird that he waited until they were hemorrhaging money to inject money into him while calling him the greatest investor of his generation. Like, wouldn't you invest with him from the beginning, not when he's about to, lose his fund? It just doesn't make sense. And then you gotta ask, why would they do that?
I agree, it's very weird. The whole sequence of events, I'd say relatively shady. But I think a lot more information will come out over time, and it'll be interesting as it does.
Yeah, I don't know, because just me personally, the amount that they injected was the exact amount that their business partner needed at the time. And you'd think with...
Do we have a short recess?
Yes, of course. Recess for 5 minutes. This honorable court will now take a brief recess.
Yeah, they know we're waiting, so they just
Judges,
they
if you
throw a
could please
5-minute
give me 1 minute
recess.
while I put everybody back
Wait,
to
they're crazy late, and then the first thing they do is take a recess?
Sorry, guys. So I'm sure you just heard that. Yeah, they're the Citadels next. They just took a 5-minute recess, so we have 5 minutes, and as soon as it starts, I'll get it ready to go.
Another question I have here: is it possible to see some kind of data access to ATS for retail? What would be the best way?
Data access to ATS? I'm not.
Yeah.
What is that? Is there anything more than that? I don't know what that means. Like, you can go to the FINRA's transparency website, OTC transparency website, and see like where things are trading on which ATS and which OTC market maker. I think the delay is, for some data is 2 weeks and other data is 4. You can't see which ATS something trades on in real time. Off-exchange prints don't include the venue that they traded on.
Right, it's kind of the nature of the off-exchange network.
Unless you're an institution. So if I'm an institution, right, and I'm routing orders to several dark pools, I know where I got my fill from. But from a market data perspective, nobody knows publicly.
How big of an impact to Citadel and to the overall market quality does this case represent? How much liquidity could Citadel lose, and what a win means for retail? I don't even think it's really necessarily a matter of liquidity at this point. It's just more a matter of them operating the way they want to operate, and what it means to retail if they lose, in my opinion, is one door closed.
Yeah. I think that it's, the more I think about it, the more I think it's a very long-term play either way that it goes. And so, like I was trying to explain before, if this order type exists and lots of data starts to come out that shows how good it is from an execution quality perspective, it just, it makes it more and more difficult for firms to not use it from a best execution perspective. And so all of this is sort of wrapped up in that. If there are conclusive, examples and conclusive information and studies to show that routing to in other ways into other places results in better execution quality, it makes it a more difficult argument to maintain the current status quo on internalization and wholesaling, as well as to maintain the current status quo on routing for fees and rebates. So, over time, it could mean that, then payment for order flow and off-exchange internalization without material price improvement goes away, and then more orders have to get routed to exchange, and, routing practices around exchanges have to demonstrate best execution. I fear that's sort of a naively optimistic way of looking at it, that actually data will take the argument and carry the day, and it just never tends to. But, I think that's probably one way of looking at it, at least.
Is it oversimplification to say that, in essence, Citadel doesn't expect to win this case? They just serve their purpose of pushing off the outcome of the case and the efficacy of it being, actually administered or enforced?
Again, I don't see, because again, it was approved and it's active. I'm not sure. First, I thought about that as the delay tactic, but it almost seems like they just want to waste resources, SEC and IEX resources. Is one of them, maybe another way to look at it. I don't know. I don't know what they expect to accomplish with this, actually. I'm kind of at a loss on it. The more I think about it, the less I become convinced of the reasoning that I had
originally thought of.
Yeah.
So, Ticker Junkie here, I got to read this just because it's not a question, but it's an analogy, and I love analogies. So, his analogy is when we buy or sell a stock, it should be like buying or selling an antique. It's a unique interest in a company or artist. Antique dealers don't make fake paintings for liquidity. How did the stock market get so twisted?
All right, guys, here we go.
Citadel Securities LLC petitioner versus Securities and Exchange Commission. Mr. Wall for the petitioner, Ms. Parisi for the respondent, Ms. Stetson for the intervener for the respondent. Good morning, Mr. Wall, whenever you're ready.
Good morning, Your Honors. May it please the Court. The SEC has allowed a small for-profit exchange to interfere directly in the market in order to attract one side of that market and boost its revenues. In approving that change, the Commission committed 3 errors that independently require reversal. First, the Commission seriously misunderstood the data before. Rather than look at particular trades, the Commission relied on misleading statistics that show a lot of trading when the signal was on. Those statistics reflect normal trading activity, not phantom arbitrage. Large orders across multiple exchanges cause prices to move, which turns on the signal. Even after Citadel submitted data showing exactly that at Joint Appendix 372, the Commission never addressed it. Second, even as
Mr. Wall, you just referred to phantom arbitrage. Do you think latency arbitrage exists?
Judge Walker, I don't think the Court has to get into it. All the Court needs to say is that if it exists, data here doesn't show it.
Well, but part of the argument is whether or not the algorithm, speed bump, and all of the things that IEX have done here is sufficiently tailored enough to reduce latency arbitrage. And I couldn't tell from your brief whether your client acknowledges its existence even. And if you don't acknowledge its existence, it's hard to know how you can make an argument that the algorithm and the speed bump are not sufficiently tailored.
Judge Walker, I think there's good reason to be extremely skeptical. 10, 12 years ago, sure. Now, no. Look, there are a lot of dogs that ought to be barking. This is the phenomenon that they say it is. The SEC has all the trading data in its MIDAS system, and IEX has access to the trades too. You'd think that somebody would be analyzing the actual trades to give you examples of latency arbitrage. Or you'd at least have first-hand accounts of people who were saying that particular cables were shorter, or here are the firms that have the better data speeds. In fact, the amici in this case, like XTX on the other side, which is one of Citadel's competitors, has the same connectivity and data. I doubt Ms. Parisi and Stetson will tell you that they have any competitive advantage or disadvantage vis-a-vis Citadel. So I think there are good reasons to be skeptical, Judge Walker, about whether this narrative in this day and age is true. But again, I don't need the Court to agree with me on that. All the Court needs to say is, look, they took there to be a problem because they took these numbers and said there's a lot of trading when the signal is on. And the numbers are meaningless because it's large trades that are turning on the signal. And that's the example that we gave at page 372 of the joint appendix. If you look, we supplied an actual trade to IEX and the commission and said, we sent out a large buy order across multiple exchanges because we were sweeping the market. We wanted a lot of shares of this particular stock. And IEX, because of the speed bump, looked at what was happening on all the other exchanges, correctly predicted that because there was a spike in demand, prices were going to move. It turned on the signal, and then you can't execute the last little piece in IEX. And the key...
Mr. Wall, you can finish your sentence, please.
Oh, I was just going to say, Judge Walker, the key thing to understand is that IEX is a thin player. It only has about 2% market share. It doesn't have a lot of liquidity. There's, so to speak, there's not a lot of stuff sitting on its shelves. So if you're going, you're often going because you need a lot of something, including the last little piece at a place like IEX, and it's that last little piece that's making the signal turn on. It's got nothing to do with latency arbitrage.
Let me ask, IEX says in its brief that you carefully avoided telling the commission in this court two things, and so I wanted to give you the opportunity to answer them if you want to, or to confirm that Citadel would rather not. The first is this: Citadel carefully avoided telling the commission in this court how much of its trading activity, when the indicator is on behalf of retail investors.
So not true. As we explained.
So how much of your trading activity is on behalf of retail investors when the indicator is on?
So we looked at 1 month of data, and as we told them at page 313 of the joint appendix, we said more than 50% of the trades we sent you in 1 month, it's actually 56%, were retail rather than proprietary. And of those, Judge Walker, we said 15% turned on the signal because they were sufficiently large. It was the size of the order that was driving this. It had nothing to do with latency arbitrage. In response to that, here's what the commission did. It said, okay, you say we mislabeled you as proprietary when in fact you do retail. We're just going to exclude your data from the analysis.
Right, I caught that. I remember that part. Let me ask the second thing. They say you avoided telling the commission in the court. They say you did not say whether retail investors, as opposed to Citadel, benefit from routing retail orders at the moment the indicator is on.
So, not true, Judge Walker, but it's the flip side. As we explained to the commission, the retail investor is harmed. We're not bundling these retail orders. There's some anonymous comment letter. It provides no support for that. We told the commission it wasn't true. It's not true. A retail order comes in. Maybe we fill it internally if we have the volume, or we send it out to the exchange. We send it out quickly, we send it out promptly, and we do it across all the exchanges if it's a large order. Again, we gave an example at page 372 of the joint appendix. And what happens is, let me give you a really simple example just to make it concrete. Let's say you want 1,000 shares of Apple. There's 500 on the New York Stock Exchange, there's 400 on NASDAQ, and there's 100 at IEX, right? You hit the New York Stock Exchange and NASDAQ, you get your 900 shares. IEX sees that going on. It correctly predicts that because of the spike in the demand, the price is going to move. It ticks up a cent. So for those last 100 shares, that retail investor, you wanted 1,000 shares, you're a mutual fund, or you're investing on behalf of ordinary folks, you pay an extra $1. Their only answer to that is not to look at the retail cost. They never consider that at all. All they say in the order and in the brief is, well, you can just reroute. But the problem, Judge Walker, is now you jump from the frying pan into the fire. If you executed IEX first for the 100 shares, it's true, you don't pay the extra $1. But you hold back the other two orders for the 900 shares. And as we told the commission, by the time you send them out, the shares may not be there, or they may not be there at that price. So you're sort of damned if you do, even more damned if you don't. And if the commission had looked at all of this in some reasoned order and said, here are the benefits and the costs, I grant it'd be a tougher case. But essentially, they haven't looked at any of it. They say at page 41 of their brief, you can just reroute. We come back and say, well, you said in response to the CBOE proposal that routing wasn't enough. And then they drop this footnote at page 55 to say, well, you're not going to need any material changes in routing. The brief is totally schizophrenic on it. You will need to reroute. That rerouting has costs, and the commission didn't consider those costs.
Mr. Hall, is your argument that are you making an argument that the SEC lacks the authority to counteract latency arbitrage? So if they had provided more reasoning or more data, that they could attack this problem Or is your argument that they just simply don't have the authority under their statute?
No, only on the second of the protected quote side, they can't do what they're doing. They can't protect the quotes because it's not consistent with the language of the regulation. But on the first of the two issues, the Dlimit argument, no, Judge Rao, if they had come in and presented actual evidence of latency arbitrage, they presented actual trades or even first-hand accounts for people who were writing the algorithms involved, if they had some reasoned basis, and then if they had shown, look, we've isolated out the retail, we've isolated out the ISOs, the intermarket sweeps, we're still showing that we're actually picking up the arbitrage. We know that's going to impose some cost on retail investors on the liquidity taker side of the market, but here's why we think those costs are overbalanced by benefits. I mean, if they've done what you would expect in a well-reasoned commission order, I think it's possible they could have done this. But this is just a sloppy order. It takes data, it misreads the stats, it assumes away all the costs. If you look at both the order and their brief to this court, it reads like it's all roses and no thorns. It doesn't have any consideration of the costs on retail or routing. And then just to finish up where I started, Judge Rao, at a minimum, and this was the third error I was going to get to in my opening, they can't protect the quotes. The regulation says immediately and automatically executable. And the whole point of this is they're slowing it down so that it's not immediate. And then instead of automatically executing, they're automatically repricing. They're doing the exact opposite of what the regulation says. And so, no, on that side of it, they can't do this absent another notice and comment ruling.
Mr. Wall, a question of immediately. The commission claims that it should get Kaiser deference for its interpretation of immediately, and it made that interpretation in 2016 when they did the initial IEX order. So why shouldn't they get Kaiser deference in this context?
So I'd say two things, Judge Rao. First is you don't get our if the language is unambiguous. And there's the natural meaning of immediately and automatically is exactly what you think. No intentional delay and no intervention. And that's exactly what the contemporaneous guidance said in 2005. If you look at page 534 of the adopting release, it is almost word for word what I just said. You are right. They came back in 2016. They read in a de minimis exception that has no time whatsoever to the regulatory text. So first, I don't think the text is ambiguous enough to allow them to do it. Two, Justice Kagan already told us in Kaiser that an agency will rarely get deference if it flipped, as it did here. And boy, this doesn't seem like a very good candidate for that at all, because when they flipped in 2016, all they talk about is the purposes of the Act. They don't make any effort to tie it to the text. Even the discussion of policy is pretty thin. And then when they revisit it here in 2020, Judge Rao, and this is at the top of page 83 of the Joint Appendix, it's literally two sentences. And only the second sentence doesn't even work, and all it says is, we looked at this in 2016, and for the same reasons we're doing it here. Except that here they're doing it for displayed prices. This is supposed to be the prices that the market tells you the fair value is. And they never looked at whether repricing those frustrates the Exchange Act and its purposes.
Citadel, though, didn't challenge the interpretation in 2016, did it?
Well, in all fair, not to this court, Judge Rao, we did challenge the commission, put in comment letters pointing to the regulatory text. Now, but at the time, they said we're only doing this with non-display, right? The stuff you can't see that you just want to go fishing for in the dark. But we're not doing it to display prices. So we didn't petition this court for review. It wasn't until they did that here that we've come in, obviously, and brought it to this court. And at the end of the day, Judge Rao, if I'm right that they can't take advantage out, then it's just a regulation. And what does it mean for a quotation to be immediately and automatically executed? It means you can't slow it down at the exchange, and once it hits the exchange, you can't tinker with it. That's the whole meaning of immediately and automatically. And what they've done is say, well, not immediate, but as long as it doesn't take too long that we think it frustrates the purpose of the Act. And they flipped the default of automatically. Never interpret that word. Instead of automatic execution, you get automatic repricing. It's the exact opposite of what the regulation requires. So, look, we have both the frontline argument, by the way, that it's not consistent with the reg, but the fallback argument, by the way, Judge Brown, doesn't attack at all 2016 or isn't inconsistent with it. Even if this de minimis gloss can somehow be put on the regulation, they still didn't here offer any reasoned basis for saying, here's why extending that to displayed prices doesn't frustrate the purposes of the Exchange Act. There's no analysis of that in the order. As I say, it's two sentences at the top of page 83, and all it does is point back to 2016, which of course never looked at this extension for displayed prices. That argument we have regardless of what one thinks about 2016.
Why would the interpretation of immediately and automatically be different for displayed versus non-displayed?
Well, I don't think it leads our frontline argument. Our frontline argument is they got it wrong in 2016. Fine. They get the benefit of that for the purpose of the exchange. Extending that to displayed prices doesn't frustrate the purposes of the Exchange Act. There's no analysis of that in the order. As I say, it's two sentences at the top of page 83, and all it does is fallback argument is which of course never absolutely mentioned for displayed prices. Say, that argument, even regardless of doesn't affect what one of the stuff that we're hearing in the dark that you can't
What would the
see,
interpretation
it does very much frustrate
immediately
the
and
purpose of the
automatically
Exchange Act
different
to do it
for
with respect to
displayed versus
displayed
non-displayed?
right?
Oh,
Because the whole idea of this protected quote system, which doesn't apply to only for displayed quotes.
Vulnerabilities of it.
You got a best
Especially when you have, internalizers that are reporting.
And once you have them, everybody's required to trade in them. You can't mess up the investor by trading at some different price than you can get on some other exchange. But the whole system, or the reason you offer that insurance to the investor is because you're confident that the bid and offer are actually the best prices out there in the market, driven by market forces. Here, they're requiring us to treat these things like they're the best bid or offer on the market, when we know that when we've got a large order, we're going to get to IEX on the very last piece, and it's going to fade away from us, right? We have to treat it like it's real when we know, in fact, it's phantom. And that's at odds with the system. And if the SEC wanted to try to do it for displayed prices, it at least needs to explain why it doesn't frustrate the purposes of the Act. And it didn't even try it.
Do my colleagues have any questions? I have one more question. So I guess I wanted to understand more about this question about asymmetry. So all incoming traffic has to cross over IEX's speed bump.
Sorry.
That's correct, right? So it's symmetrical as to the speed bump.
Well, sorry, Trevor, it was for the non-display, right? But this automatic repricing makes it asymmetrical because, you put the quotation up there, and while everybody else is trying to hit it, get through the speed bump, and execute against it, they're automatically repricing during that 350 microsecond delay. So it's now asymmetric, and it hurts just the liquidity taker side of the market.
But doesn't the SEC routinely approve FX? And isn't that the same difference here as it would be with other types of orders that move in that way?
So I don't think so, Judge Rao. I'm not here to tell you. Obviously, the question is whether it's unfair discrimination under the Act. Sure, there are some kinds of discrimination that are not unfair. But it seems to me if the Commission wanted to justify this, we know it's discriminatory. We know it helps liquidity providers, hurts liquidity takers. I don't think anybody doubts that. So the question is just, is it unfair? And it seems to me they've got to do two things. They've got to be right, or at least fair and reasoned about the benefits, right? What they're attacking. They've got to correctly understand the problem and what they get from it. And they've got to correctly understand costs. And here they messed up both sides, right? They took as evidence of latency arbitrage something that's just evidence of normal large trading. And then they assumed away the costs and sort of said, well, you can deal with it through routing, but not looking at the costs of rerouting, which, as I tried to explain earlier, Judge Walker, are real. So if they'd done that on both sides of the ledger, maybe, as I said to you earlier, they'd be able to get away with a proposal like this. But in no event can they protect it. They have this innovation story they want to tell. That's fine. If they're right about this, let the market decide. Liquidity providers should flock to IEX if they're right. But what they can't do is let the platform itself start monkeying around and interfering with the trade, and then claim that those are protected, not without a change to their rule. Their rule says immediately and automatically. The whole idea is if you've got the best bidder offer driven by the market, you get protection. It's not driven by the market here. It's driven by a formula that the market is using to readjust the price that is the result of market forces. So If they want to do this, let them do it, but let them compete as they say they want to. Don't let them do it, having interfered with the market, and then claim this protectionist benefit of Rule 611.
And so your argument is that rule has to be updated through notice and comment rulemaking.
Yes.
The SEC wants to update it.
Yeah, I mean, look, if they want to say it doesn't have to be immediately and automatically executable, you can have an intentional delay, and you can have intervention by the agency. It's perfectly fine. You just got to choose different words. But again, Judge Rao, you don't have to agree with me on that, because even if I'm wrong, and there is some de minimis exception that can be read into that language, notwithstanding its natural meaning, they still here did not do what they tried to do back in 2016. They didn't say, okay, we're extending it to displayed prices. Here's why that extension doesn't frustrate the purposes of the Act. They pointed back to 2016, but of course in 2016, they were never looking at displayed prices. So they've got an APA problem anywhere they go, although I will say I think that it's more fundamental than they recognize.
My colleagues have any further questions? Okay, thank you. We will hear next from the SEC.
Good morning, and may it please the court. Emily Truparisi for the Securities and Exchange Commission. The Commission's order in this case, approving IEX's proposal to offer its customers a new order type, was the product of reasoned decision-making, supported by substantial evidence, and should be affirmed. I would like to go straight to this idea that it's large orders that are turning on the CQI, which is something that I heard from Petitioners Council. The Commission orders that were turning on the CQI. What the Commission found, looking at the data in the record, is that it looked specifically at the extensive data in the record for what was happening at the time that CQI, these small milliseconds and microseconds. And it found this stark disparity between the volume of marketable and displayed orders that were being executed versus non-displayed. And it's important to unpack that a little bit, because the displayed versus non-displayed shows that the activity is targeting the orders that don't have the protection of the speed bump in the CQI, and the marketable orders shows that it's the aggressive orders taking it. It's not the Bitcoin orders, it's the ones that are crossing the spread aggressively. So there was extensive data in the record showing that the CQI only turns on when it's aggressive order taking, the hallmarks of latency arbitrage. Then you look at the qualitative data in the record that the Commission had before it, right? Numerous commentators wrote in saying that they could not trade in that manner, and that those that do use these large orders, these intermarket sweep orders, would not have any problem billing, because the Commission made extensive findings that the accounting for this de minimis speed bump, IEX's speed bump, is something that is commonplace in order routing. There would be no additional cost because it's commonplace order routing that people already have to take advantage of, take account of, because the delay at IEX is no different than the geographical latencies that are inherent in all the different exchanges.
What do you say to counsel's argument that this is inconsistent with the immediate and automatic language of the existing regime?
Sure, I'd be happy to go to that argument, Your Honor. So we think that the language really here is right clear, and I think it's just a misunderstanding of what that Rule 611 inquiry is getting at here, right? So Rule 611 says that, protected quotations can't be traded through, and then you have to use the definitions to figure out what protected means. So in order to be protected, it has to be automated, and that's really the question here. Are these quotes automated? If a court to take a step back and think about this, there's only two choices. It's either automated or it's manual, right? So, and it simply makes no sense to think of these quotes as manual. That's you think of a trading floor and a human sort of intervening. These quotes are not manual; they are automated because they immediately and automatically execute. And to focus on the word immediately, as I've heard some of the discussion about, it cannot be that it has to immediately has to mean literally there's no delay at all, because all quotes experience some delay, and the Commission explained this very clearly in its automated quotations interpretation that it issued in 2016, right? All quotes have some geographic latency, so you can't take immediate to mean it, which is literally mean there's no geographic delay whatsoever. So once you've taken account of the premise that there's some geographic delay, the question is, well, is this de minimis IEX delay any different, and it's not. The Commission found it well within the same kinds of geographical latency limitations that all other protected flows hit. So it's quite simply consistent.
Ms. Cruz, so my question about that, immediately, isn't the natural meaning of immediate? Sure, there might be a geographic latency, but if someone takes an intentional action to impose a delay, even if that delay is very small, as it is here, doesn't that mean that it's not immediate? So when there's a geographic latency, immediate is just sort of limited by technology, how immediate can something be? But if someone takes an intentional action, an intentional delay, that doesn't strike me as consistent with the natural meaning of immediate.
So, Your Honor, Citadel made that exact argument in 2016 in their comment letter about the plain meaning, and the Commission addressed it in 2016, and it said there's nothing about the intentionality of the delay because it's simply the same from the perspective of the execution as the geographic delay. And so, to the extent that the intentionality piece comes in, it just doesn't come in the Rule 611 analysis. The Rule 611 analysis is simply about the duration of time, and the intentionality piece doesn't come in there. It may come in terms of
the protected quotation side of things, right? Because the idea is that it's protected quotation because of market forces, not because of an algorithm, as Mr. Wall said earlier.
Well, it's protected because it's sort of just, it's a factor from the definition. It's protected because it's automated, and it's automated because it immediately and automatically executes. And it's important to go back, I think, Your Honor, to answer your question to Reg NMS and what Rule 611 was supposed to do. The idea there was to encourage automated trading as opposed to manual trading, right? That was the specific purpose of the trade through exception in 2005. It gave the protected flow status to automated trading as opposed to manual, because manual was too slow. And so the idea was to encourage automated trading. And there's just nothing that's not automated. It makes no sense to think of IEX's flows as not automated. It also doesn't make any sense to think of only the Dlimit quotes as not automated and therefore protected, because then you have a strange situation where some of IEX's quotes are protected, but only the Dlimit ones aren't, and people trading don't know which is which. So it just doesn't fit under the structure of the regulation itself to not consider these quotes protected and therefore automated. The questions about access to the liquidity and what Mr. Wall was referring to as phantom liquidity, that is addressed extensively by the Commission, but under the Exchange Act analysis as opposed to the Rule 611 analysis. And the Commission found that there would not be extensive quote fading, but that goes to that analysis. The Rule 611 analysis is really very clear under the terms of the statute. You're either automated or manual. You're automated. You're protected under Rule 611.
What do you say to the argument that the SEC itself caused the problem of latency arbitrage that IEX is going to elaborate links to solve, because the cause of latency arbitrage was Reg NMS?
Your Honor, I think I would say that the issue before the Commission here is whether the order is consistent with the Exchange Act, and so the Commission has to take these things as they come. The Commission is balancing competing policy concerns in terms of the Exchange Act and 11 Cap A and the congressional directive that is out there to create this national market system. But the issue here in front of the court is simply whether IEX's proposal to offer this new order type to its customers is consistent with the Exchange Act. And the Commission found that it clearly was. There's extensive data in the record, and I did want to touch on. I see my time is up, and so I just wanted to quickly touch on, with the court's permission, the idea that the Commission ignored Citadel's data. It simply did not.
Before you do that, though, and I understand it's not perhaps directly related to the question before us, but it does seem to inform it. Do you agree that Reg NMS was sort of the first mover, the cause of all this latency arbitrage trouble that Citadel says doesn't exist, but IEX says does exist, and SEC does exist, and IEX is trying to fix.
Your Honor, I think pinpointing the cause of, a market phenomenon like latency arbitrage is a very difficult thing to do, and I don't think the Commission has said anything that, certainly, regulations can have consequences, both intended and unintended, but I don't necessarily agree with the petitioner's characterization there.
Can I just ask you, since briefing in this case, have other exchanges sought to follow IEX's model? And if so, how has the SEC handled those proposals, if there have been any?
I don't believe there have been any. Occasionally, someone will copy a certain feature of the plan, but then sometimes they will take some back. But I don't believe there's any true copycat of this proposal in the market. And precisely because to do so, you would need to already have the infrastructure. You need to have speed bump and the steep decline, and all the pieces that go up that lead up to the Dlimit order yourself. And there simply aren't any other exchanges that have all that infrastructure. I don't believe there are any other copycats.
Thank you. Okay.
Unless the court has any questions.
Thank you very much.
Now we would ask that the order be affirmed. Thank you.
We'll now hear from Ms. Stenson.
Good morning, Your Honors, and may it please the Court. I'm Kate Stenson, representing IEX as the intervener. I want to make just a couple points on the primary argument in this case, the latency arbitrage issue and the solution that IEX devised. And then I do want to be sure to talk about this immediacy issue, Judge Santel and Judge Rao, that you raised as well. But just on the latency arbitrage point, and Judge Rao, I think one of your questions pointed at this as well. This primary argument of Citadels is a substantial evidence argument. That's unusual. Usually there's a lack of statutory authority argument or some other more significant APA hub. So here, what we are looking for is, was there substantial evidence in the record that latency arbitrage occurred? And the Commission found yes. Those sites include Joint Appendix 62, 87, 89. When was latency arbitrage happening? The Commission concluded, based on IEX's several months' worth of data, that it is happening in those microseconds right before a price changes. And I want to mention something that Mr. Wall said about the dogs barking if there is data of latency arbitrage. There are so many dogs. There are so many comments in this case from hundreds of investment advisors and companies representing trillions of dollars under management and millions of investors, including, among others, high-frequency traders, XTX and Virtue. Virtue in particular does precisely what Citadel does. We can talk about what we're calling the retail issue in a minute if you all like, but understand that Virtue supported this Dlimit order and does exactly what Citadel does. With respect to Mr. Wall's other comment about this evidence that IEX put in over several months of data in which the Commission evaluated and accepted as evidence of normal large trading, that is simply not true. What we are talking about is evidence of a huge amount of trading going on in the few microseconds before a price changes. I just happened to blink my eyes. That blink is about 200 times longer than the couple microseconds that we're talking about. So when Citadel talks about routing 15% of its batched retail trades at that very moment, that is Citadel trying to hit that stale quote. That is what is happening. It is not evidence of normal large trading. With respect to the data that Citadel put forward, and I want to make clear, there is a difference between disagreeing with a commenter and ignoring a commenter. And I think a lot of what Citadel's brief tries to do is to shoehorn this into some model where the Commission didn't ignored Citadel's data, didn't pay sufficient attention, and there is a huge amount of work that the Commission did in this order to take into account that data and to talk about it and explain it. And one of the things that Ms. Parisi mentioned argument is that data comparing the difference between what's happening on the displayed order side and what's happening on non-display. The other thing that I would mention is the Commission's finding in Appendix 55 to 56 that the people who are doing those trades, the entities doing those trades in those microseconds, are proprietary trading firms, high-frequency traders. Those high-frequency traders include Citadel. Citadel is trading on behalf of retail investors. That's the phrase it uses. Citadel pays millions, hundreds of millions of dollars to brokers in order to get those retail orders so that it can batch them, route them as it sees fit, internalize them if necessary, and profit off of them. That's Citadel's model, and that's why the retail investor is really just a red herring. Let me touch briefly. Yeah.
Just to make sure I understood what you just said, are you saying that when Citadel says that 40% of its trades on IEX are on behalf of retail customers, that in fact those trades could be using latency arbitrage tactics?
100% true. Yes.
And then I hope Paul will address that in rebuttal if he disagrees.
That is exactly right. And that explains, as I mentioned, Judge Walker, why such a vast percentage of those trades is happening in those couple microseconds. You have dozens of commenters saying we cannot use the technology that these high-frequency traders have in order to do this. There's a comment from Themis Trading that says we are in the middle of a speed war that we never signed up to fight. The only people who are able to exploit those microseconds are high-frequency traders like Citadel and like Virtue, which supported this order. I know my time is up, but I do want to briefly...
I do have one question. Citadel suggests that really it's IEX that's engaging in latency arbitrage by repricing, automatically repricing when the indicator is triggered. I mean, what do you make of that argument?
I think, to begin with, I think it's a little bit rich because I think as even some of Citadel's amici acknowledge, and I'm talking about the Vollmer brief at footnote 5, there have been a number of innovations that other exchanges have implemented, including NASDAQ, NYSE, that are designed to either supply co-location, more auspicious location for a fee, or faster data connections for a fee. So far from latency arbitrage, what IEX was founded to do was to actually try to level the playing field so that the daily investors, the people who are actually putting retirement money into retirement funds that are managed by these long-term fundamental investors, that they have a shot. Because no one else is able, as I said, to exploit those microseconds except for high-frequency traders. The other thing I guess to mention, Judge Rao, is when that price crumbles, that is what IEX is doing in those moments is essentially fighting fire with fire. Because the reason that the high-frequency traders are able to exploit those microseconds, those tiny moments, are because they are anticipating the price change. That's exactly what IEX is doing. So to say that we're engaging in latency arbitrage when we're actually trying to level the playing field, I think is a bit of a misdirection. On the immediate and automatic point, I don't think, Judge Rao, that it's right to say that a speed bump delay like IEX is somehow qualitatively different than, say, a geographic delay. Exchanges make choices all the time about where to locate their servers. Should we locate in Mahwah, Chicago, Miami?
This is bullshit!
Make choices all the time.
This is fucking bullshit!
High-frequency traders all the time for even locating...
No, it wasn't, you fucking fucker!
In order to make sure that those servers are more quickly connected. Exchanges for agents
No,
are trying to make sure that to the extent everybody's paying the same price, located in different parts of the room, that there's extra cable in order to make sure that there's no tiny latency between the server at the north end of the room and the server at the south end.
It's the wrong fucking address!
Are examples of what we would call geographic latencies, but they're just as intentional as anything that IEX designed. And what the Commission concluded in 2016 was that the immediate language means
wrong
something
fucking
that
address!
doesn't interfere with fair and efficient trading. Now, the argument Mr. Wall offered, Ms. Gracie is exactly right. This is exactly the argument that was offered in 2016
Didn't come to the door, order not delivered.
Immediate, though, does
Nor
not mean
driver unprofessional, driver late.
If you, Judge Rao, asked me to come to your chambers immediately,
Come on, man.
it would take me a while to get there. If you asked me to come to your chambers instantaneously, I would say, I'm sorry, I have
wrong address.
There's a difference between immediate and
All
instantaneous,
food.
and that difference is within the
All food was
commission's
ruined.
bailiwick and purview to interpret.
In the
What
rain.
it came down to in 2016 is exactly what it comes down to today.
Freezer
Which is,
items.
does this de minimis delay interfere with the fair and efficient execution of the
Complete
order?
refund needed.
What IEX's
Your view, Ms. Stetson, that immediate is
Cash
ambiguous, so we
items
should defer to the SEC's
were
interpretation?
stolen.
I think that is the SEC's position, and I can see the merit in that position for precisely the reason I just said. I think when people think about immediate, and you're not thinking in terms of these eye-blink moments, immediate might mean something very different. But when you're talking about these eye-blink moments, immediate has to mean something that's a little bit more accommodating. It's exactly why the commission, even with its protected quotes, builds in a 1-second essentially grace period. No one is found to be in violation of the rule as long as that quote changed a second or less before whatever order they executed. There's an acknowledgement that the systems can only go as fast as the systems can go. And here where you have targeted, sorry, Judge Citadel.
It bothers me that you in what you just said, your statement is just the geographic delay, if you would, between immediate and instantaneous, recognizing that that's as fast as system can go. Here you are deliberately putting you're not, but the rulemaking is deliberately putting a delay into the course of the transaction that takes it out of the instantaneous, but may also take it out of the immediate. Isn't there a difference between the geographic delay that is inherent and unavoidable and the inserted delay of the roadblock, which is inevitable?
Judge Santel, two answers. The first is that, as Ms. Parisi mentioned, that is exactly the argument that was made in 2016, in which the commission thoroughly evaluated and rejected. The second answer is, as I just mentioned to Judge Rao, the idea that
I'm so mad right now. I'm so sorry. I'm very fucking
simply
mad.
not the case.
So sorry.
Exchanges make choices all the time
The driver did
about
not
where to
call me.
locate
The
their
driver
servers,
dropped it off
how
at a different
fast to
address.
connect their
It's
particular
raining
customers
really hard
to
outside,
the
and I'm
server,
pretty sure all my
where in the
stuff's
room,
ruined.
as I
I don't
said,
know
to
where
locate
it's
the
at.
server. Those are all
And they did it 2 hours ago without notifying me. It was already
so
late.
drawing a
And I
distinction
let it go. You know,
the
I let
kind
it go.
of coil delay that we're talking about here,
I'm so fucking
and the
mad.
kind of coil delays that are common in other
I want a
servers,
complete
including, as I
refund on
said,
the
to try to equalize high-frequency traders' access. There are slightly different from each other in a room, such that one
You need
gets
the order number? Okay, I'll get it for you. Because I'm going to have to walk all the way there and go pick up the order. I want a complete refund on
in
this.
2016 and reiterated here is
The order number is 56
in this context
8 2
means a
1
delay that is
6
so de
2
minimis.
6
It's not
6 6 4 3 9.
there's no human interference, which was the whole
No,
reason
hold on.
why
I don't even know if that's it.
immediate
Oh,
order
God.
began to exist. It's so
Yeah,
de minimis
that's
as
the one.
not to interfere with fair
Total
and
charge
efficient
209.
access. And I think what Mr. Wong's client is seeking
If it was for
is what
what's
we
it
would
came
say is unfair
my
access,
girlfriend.
because they are seeking to exploit
So it should have
that
her name on it.
tiny moment of time when the price is changing before other people, other liquidity providers, and liquidity takers are
They
able to
didn't
get
follow
there.
the
And I want to
directions I placed
perhaps
on there.
end on this, if there are no
I'm pretty
further
sure it's all
questions.
ruined right now
This
because
is
it's been raining for
discrimination
hours.
against a type of
And it's just sitting
high-frequency
outside.
trader that
So
engages in predatory latency arbitrage. That is the
there's
discrimination
no
in
like checks and
2027
balances
we're
you
talking
guys
about.
go through
What
anymore.
the
You guys
SEC
used to call.
what
I don't
IEX
understand.
submitted and what the SEC evaluated and adopted was that this Dlimit order
I'm so
helps
mad.
the market overall. It helps
I
liquidity
can't just go
providers.
and pick it up. I got kids, man.
That's why you have
I can't
XTX
just walk there. I don't know
joining
where
these
it's at.
comments. It helps liquidity takers because it ensures that liquidity actually exists and isn't just shifting over to the dark markets or off exchange. This order helps the market overall. The people it doesn't help are the people people who are trying to essentially spin that predatory tax off of a change in price. There are no further questions. Any questions?
I'm gonna have to go and find it now. We need this. We need the stuff, man. I wouldn't have ordered it a day before, you know, if I didn't need it today.
It's ambiguous, and you also win in the
The letter.
Yeah, I'm gonna need
The
the whole
letter.
thing.
And I think what the SEC said in its brief, I think in a footnote, is that the interpretations of deference under Kaiser, that's clearly true, just given the length and the thoroughness and the consideration, the specificity of what we're talking about, the technicalities of what we're talking about. But if it's unambiguous, then we will also consider that sort of thing.
Okay.
Thank you, Ms. Dunford. Ms. Raw, I'm not sure you have time left, but we will give you an additional 2 minutes for rebuttal.
So, 3 quick points. Let me start with Rule 611. You were right, Judge Walker. Regulation and investment create the fragmentation that protected flow, stitches it back together, and it's important you enforce it. The language of the regulation is not anything about interference with fair and efficient trading. It doesn't immediately and automatically executes an order. You're right, Judge Rao. Immediate, of course, things take time to do. You're not doing them immediately. Introduce an intentional delay. It's no longer immediate. When you tinker with the quote, it's no longer automatic.
Can you respond to Ms. Stetson's point that it's actually, that there are intentional ways that that traders affect geographic latency, so it's not really qualitatively different to have something like the speed bump?
Sure, so 2 points. One, it's not true in practice. We explained in 372 in JA. When we have a large order, Citadel sends it out to the exchanges simultaneously. Sure, there's a little bit of geographic latency between different exchanges, but the difference isn't large enough to allow anybody else to see what's happening on the other exchanges and react. So because we have a best execution obligation, we send it out everywhere at once. This is lengthening the delay, as Judge Santel said, and it allows everybody in IEX to see what's going on. And then they reprice. The second thing is, it's just not a natural language. Sure, I tell my kids, you're in bed, get out of bed, turn on the light, and in case you think there's a countermeasure, all you need to do is look at the adopted rules with Rule 611. It says at page 531, not any other type of additional device that would delay the action. The commission read it exactly the way you did.
Mr. Wall, it seems that Citadel pays for those devices on several other exchanges. So tell me if I have facts wrong. I'm imagining Citadel and company X that are equidistant from an exchange, and so they send a communication to the exchange at the exact same moment. But Citadel has paid extra money to that exchange so that its receiver is a little closer than the competitor's receiver is. I'm imagining a room with computers in it. There's like a box for Citadel and a box for the competitor. It's probably vastly oversimplified, but Citadel pays the exchange money so that its receiver is in a better position, a better distance, better location in that room than company X. Does that happen?
Judge Walker, I think maybe it did years and years ago. It's a wonderful narrative. I grant you, like it's a great story that the Stats are told. But no, in this day and age, it's not true.
Mr. Wall, it's not. We had a case last month about Skype's communicating between Mawa and the other things. I don't think there was any party in the case who disagreed about a lot of stuff. But none of them disagreed with the scenario where companies pay a little bit more money to an exchange like NASDAQ or New York Stock Exchange.
God, I won't. They interact.
And everyone else's little box. It's very expensive real estate.
Yeah, no, Judge Walker. What I was going to say was some exchanges deal with this by having standard tables, and the exchanges that don't have that, everybody needs to co-locate. So XDX, Virtue, Two Sigma, all the firms that Ms. Stetson named that are Citadel's competitors, they're all right there. There is no.
But aren't some that disagree?
I'm not saying they're not paying for it. I'm saying there's no competitive advantage that give rise to latency arbitrage because everybody's got the same connectivity and everybody's got the same data. They may be
There's
paying.
there's no co-location at an exchange that's slightly better than another co-location at an exchange.
Judge Walker, I don't want to go that far. What I want to say is my understanding is that's not a common problem across the exchange when you talk to traders. And at a minimum, the commission didn't put on that kind of evidence. That's the interesting thing about the order. If that's true, then what you're playing out is that's said. It ought to be easy, right? We ought to come in with examples, but there's facts on the ground, right? We can just show where the servers are and all the co-locations. The commission didn't do that, and it didn't even try to actually trade and say, here's the latency arbitrage. It looked at aggregate statistics and said, see, those show that there's a lot of stuff going on when the signal is turning on. And this was the second point I was going to make in the vote, which is none of that shows what's turning the signal on. So Ms. Stetson is right that at page 88 of the Joint Appendix, they say large orders don't turn it on. But when they say, as shown by the data above, all that they're pointing to on pages 87 and 88 is the stuff about there being a lot of trading when the signal is on. And we put in this actual order at page 372 of the Joint Appendix. We said, here's an actual order on behalf of retail investors. It triggered the signal just because it's a large order. It has nothing to do with arbitrage. And as I stand here today, having read everything in this case, I still don't understand what the commission's basic response is to the fact that this is the kind of trade that turns it on, because it makes sense, right? You're taking a lot across a lot of exchanges. IEX is watching that. Of course, it's going to predict that the price is going to move, the signal is going to come on. By definition, it's probably a good-sized trade or good number of orders, right? Because you need a whole lot of liquidity. This is a small player; it doesn't have a lot of liquidity. So then it says, oh, we have a lot of things going on in our shop when the signal comes on. Of course you do. It's exactly what you would expect. All of the markout data spread across it. It's exactly what you would expect to see if large order turned the signal on. And so I would just point back to the commission's order. And the third thing I would say, Judge Walker, to go to your column with Ms. Stetson, that's not what the SEC started. Ms. Parisi said, look, it's commonplace to do this as a matter of routing. That's not true. Citadel sends these orders on behalf of retail investors to exchanges simultaneously when it's a large order. We explain that to the commission. There's nothing to the contrary in the record. Could we reroute, hold back orders, and go to IEX first? We could, with the costs I explained earlier. Either higher costs, missed executions to retail investors who won't get the bulk of what they want because the IEX tail is lagging the New York Stock Exchange and NASDAQ thought. Now, Ms. Stetson takes it another direction. She says, oh, well, they're batching that. They're bundling it. So it's evidence of latency arbitrage. And with all respect to Ms. Stetson, that's false. We told the commission it's false. Have the supplemental agreement. We have best execution obligations. Citadel does not batch and try to time retail orders. It may fill some of them internally.
Mr. Watts, how does that work if 15% of the retail orders are coming in when the signal is on? I mean, how do you explain that?
Oh, so that part I think is fairly straightforward. Citadel handles more retail than anybody. We have 40% of the retail orders on behalf of investors out there in the country, right? So we have a lot of retail. We have some small orders and some one-offs. Sometimes IEX is good for that. It doesn't have a lot. Sometimes it has a little bit.
Thank you. I'm gonna try to see if I can get somebody to go out there and grab it. I don't know where it's at. I gotta go look for it myself. I see the picture that they posted on the thing, and I think it's like probably maybe close to a mile away from my house. I got kids here. I can't leave. So if it gets taken or if it gets ruined by the rain, then that's just gonna happen too. But I'm gonna try to get this stuff. I'm gonna see if there's anything there.
There's a lot going on with the signal
later.
Of course, there's a lot going on.
I won't even
We're
be, I
sending
can't
large
even read
retail
right now.
orders. That's the 15%. Others are sending more large orders and fewer small orders than Citadel. So that's why, even though it's only 15% for us, it creeps up to 24% of volume, 33% of orders.
Thank you.
But it's all the same.
I left the special instructions inside of the app, letting them know where my house is, where my apartment is.
There's nothing misleading about saying on behalf
They're
of
just
retail
either not looking at it and just going to wherever they think that they're supposed to go and dropping it off without calling. I don't know why they're doing that. I don't think that's the right way that they should be doing it. There should be some kind of check.
To the market in some moment of arbitrage. We'd be violating best execution obligations if we did.
How does the 15% show up in that
Thank you so much.
fraction, that tiny fraction of a second?
Oh, Judge Rao, that is the key to the whole thing, right there. They're not showing up when the signal is on. That's what the other side.
Saying they're triggering the signal.
They're triggering the signal because IEX is sitting there looking at these orders hit the other exchanges and saying, wow, there's a spike in demand or a spike in supply. So the offer is going to go up or the bid is going to go down. And so they're turning on the signal. And then the order gets there having hit the speed bump. And they treat that order, once it hits, as the volume or the order that they're talking about hitting when the signal is on. So, of course, there's a lot hitting when the signal is on. They have a formula designed to detect price changes, and they can watch what's happening on other markets. If you sort of, of course, there's a high correlation. Of course, you see crossing the spread. Of course, you see a lot of orders coming in. Of course, you see markout data showing prices running away from the
So isn't this just a race between the technology of your client and the technology of IEX to go back and forth? I mean, isn't that ultimately in the market what's happening?
Oh, I don't think so. It might be a race between Citadel and 2 Sigma and XTX and Virtue and all the other high-frequency traders that, as I said, Judge Walker, have the same connectivity and same data. But no other exchange is doing this, right? This is pretty novel. Exchanges are meant to be platforms. They're meant to facilitate trading. This is an exchange, the only one, right, that's doing this, that's reaching in and repricing the quotes themselves. And that's the sort of novel thing. To get back to where it started, if you conclude on the first issue that they can have the view limit order, even though they haven't shown you real evidence of latency arbitrage, even if they have, Judge Walker, they haven't looked at the costs. They've not looked at the cost of retail, the cost of routing. Still during the argument, no one has addressed the cost of these rerouting changes. But even if you conclude that, you can't have it be protected under Rule 611 for the reason that Judge Santel got at earlier. It just doesn't square with the language of the regulation, right? Protected quote is meant to stitch back that fragmentation we're talking about, Judge Walker, and it does it by looking at the best bid offer as a result of market forces. If they want to tinker with those, we don't think they should be allowed to. But what they can't do then is say, well, that should be treated the same as every other bid offer that is actually the result of market forces. Let them compete in the open marketplace. If liquidity providers like it, they'll go there, and liquidity takers will have to go to get the liquidity. That's what Canada did when they did the same thing. No protected quotes, let everybody have incentives to use the exchange, and decide, let the marketplace decide.
I'll stop, Judge Brown.
No, Mr. Judge Walker, you have another question, please.
Your last statement about just letting the market, play out. Here, it seems to me that's what IEX wants to do, and it's you who is going to a federal agency and saying stop a private entity, IEX, from doing what they want to do. The one who's trying to kind of regulate your way into a market victory.
So, all respect, Judge Walker, I see it a little bit differently, right? Which is, we don't want the exchange, that's right, to interfere with the market forces themselves. Private parties in the marketplace, through buying and selling, should be determining prices, not the exchanges. The Exchange Act says they are meant to facilitate a fair and open market, not that they're meant to pick winners and losers and reprice their quotes. But even if you are wrong about that, I think clearly they're not pro-market force on the Rule 611 side. If they really believe in this innovation story, they would do what CBOE did when it submitted its proposal. It didn't say its quote should be protected. It said, let us do this. The commission disagreed and flipped here for reasons it hasn't really addressed. But what IEX wants is the best of both worlds. It wants to be able to do innovation, but then say that these quotes are protected, notwithstanding the regulatory text, so that it can block the takers into coming here, which drives up its revenues. Because it's really clear, Judge Walker, IEX makes money in two ways. It makes money by having protected quotes, best bid offer, and by having more trading. This change hasn't driven up in the real world actual executions. It's not actually helping the market, but it does drive up the amount of liquidity it has at what's called the NBBO, best bidder offer. And that means more money by the millions from Ms. Stetson's client. If they want to do that in the marketplace, let them do it. But they should not be able to do it by virtue of Rule 611, either because the regulatory text is clear, or because they can't qualify for Kaiser because it's flipped, or because at a minimum, even if the de minimis exception exists, they didn't analyze it here in this order with respect to display prices. At a minimum, this court should vacate, remand with vacature of that part of the order. And obviously, we have not discussed today the remedy, but I think clearly this is the standard. If you're going to remand, you should vacate.
Thank you very much. Case is submitted.
Alright, I'll be right back. Stay dangerous or you're safe.
All right, guys. So that was a lot. So let's. We're all going to talk about it. I'm not sure the best way to handle it. First, I just want to say though, off the bat, that this was a really, I would call this a great day for retail investors. We're all here. We have about 3,700 people in this room, and I was looking at the United States Court of Appeals streaming service on YouTube, and on average, they get a couple hundred people that view their hearings on a daily basis. Not on a daily basis, overall, right? So 3 weeks ago, there was a hearing held, and it said 350 views. Today alone, there were 8,500 people listening to this oral argument today. I mean, that is an astounding number. As a lawyer myself, I don't even listen to these things every day, but at least I have some interest in them. The fact that individual retail investors and people out there actually tuned in to listen to an oral argument today is beyond belief incredible, and it really is a great day to be a retail investor. And I just want to get that point across. I know there's a lot of people in here that weren't in at the very beginning. So just a quick overview. Today's argument was Citadel against the SEC. It was an appellate argument. The standard of proof that Citadel would need to establish to overturn this SEC rule is very, very high, extremely high. It's known as what's the arbitrary and capricious standard. Basically, they have to show that the agency actions were arbitrary and capricious and abuse of discretion or otherwise not in accordance with the law. It's a very, very high standard that they have to set forth. And based upon the arguments that were set forth today, I would say that they didn't even come close. There was a lot of smoke and mirrors and a lot of arguments being made, but none of the arguments were legitimately sufficient to reach that level of scrutiny to get this overturned. Now, they mentioned a couple of things throughout the appeal, throughout the argument, in regards to standards and whether or not certain things were met. One of the things they mentioned was Kaisor, and that's another case. They were referencing another case that basically set forth a test to determine whether an agency's regulatory interpretation is sufficient, and whether or not it should be overturned. And some of the things the courts look at is whether their interpretation was reasonable, was the interpretation based upon fair and considered judgment of the agency, and a bunch of other things that basically it's like a checks and balance, right? They're saying, should we give deference, right? Ultimately, when a court has a case like this and they're looking at a regulatory agency's rule or interpretation of a rule, at the end of the day, they always have to try. They always fall back on the idea that great vast deference should be given to the agency, because after all, what's the point of having the agency if they're not going to be the ones that can be trusted with handling this type of stuff? So I don't want to be the only person to talk. So I'm gonna open it up to whoever wants to speak, and then I'll interject as we go along with myself as well, and cite specific parts of the case that I found to be interesting. And in terms of the judges, I felt that Judge Rao and Walker really were not buying any of this throughout the entirety of the proceeding. And Judge Santel, he was a little grumpy. Maybe he woke up on the wrong side of the bed or didn't get to have his coffee this morning. But yeah, I think judges will sometimes not want to show, they'll maintain a poker face or Santel. Yeah, he was a little iffy, but I still think he's going to go in line with Rayo and Walker at the end of the day. So I'm not going to keep blabbering. So yeah, if somebody else wants to talk, go ahead.
Yeah, sure. I'll jump. For everyone that was on with us before the I think it played out much as we were anticipating and as we discussed when the primary parties, two of which are before the court, one of them is leaning into the standard of review and trying to create clarity in expression and clarity of thought, where the other one is trying to obfuscate, create muddied waters. It's pretty clear just from the outset and the tone and the presentation which party has a stronger case to begin with. And I think you can see just in the styles of presentation.
I'll be right back. I'm grabbing diapers and wipes.
Their presentation was clear, but when the SEC attorney came up and just laid into this is the standard of review, this is why we satisfy the standard of review, and everything else is noise. That is the thrust of the case, and the rest of the case was about Citadel's attempts to draw conversation into exactly what their arguments were. The first two arguments in their briefs, the first of which was that the SEC failed to consider the harm to retail associated with turning off the Dlimit orders. That was a straw man argument that Citadel had set up in the first place, and I think relatively minor discussion and questions were directed towards that particular topic, and the judges just saw through that as a relative matter, which that itself is that much more frustrating that this would be the primary, the leading argument that is so transparent that it doesn't really garner much attention, much weight, and questions that are designed around flushing out what Citadel's interpretation of representing retail investors. They were all designed with skepticism in mind as opposed to drawing out elements of support. So I think that tells you where the court's mind is on that point. What I found interesting, though not entirely surprising, because it's also a straw man, is that the second primary argument in Citadel's brief is that the SEC had considered a prior similar proposed rule, 6 months ago, and that because the SEC rejected the similar rule in Citadel's characterization in that instance, but not here, that's a departure from prior practices, and therefore this is arbitrary and capricious. No one spends any time on that. Lawyer for the A's, you can correct me if I'm wrong. You were taking maybe more diligent notes than I, but I didn't hear any discussion of that, and that's not a surprise because there were so many differentiating factors between the earlier rule proposal and this rule proposal that it is the standard form and course for what to occur to happen. So I think when you're trying to budget your time, and you want to budget your time towards things that are it's clear that there's going to be weight on that particular argument or angle. So I think that argument also falls away relatively succinctly. What I think is
you need to go back
thrust
into the room now.
the analysis that will come
Go.
out is on this
So I put you in the playpen.
immediacy and whether the
I'm
Kaiser
gonna keep you in
deference
the
that
playpen all
the
day.
lawyers
Keep this
have
behavior up.
outlined quickly earlier will, number one, be triggered, and
Good
number
job.
two, if
You'll
triggered,
get off if you want.
how dispositive,
Go
how
back to the
much
room,
does that dictate
Jasper.
in this particular instance the outcome of this displayed versus non-displayed order differentiation and
Go back to
distinction.
the room.
In the relative brief amount of time that we had to consider it, there's a strong argument to be made, of course, that immediate does not mean instantaneous because of the physical limitations of the world within which we operate. And so as long as the SEC's prior 2016 analysis, which was
No.
SEC's interpretation is
Just for Michael, the only reason he's out here is because he's quiet. I'm gathering his groceries. I just had to go pick these groceries up at a different address because he dropped them off at the wrong place. I'm not having a good time right now. Okay, let me get this straightened up and all this stuff.
I think that issue, Alex, just to sort of jump in, like the immediacy issue is such a kind of absurd thing. I understand why it's getting focused on, but as with so many of these things, it's so disingenuous of an issue, right? Because first of all, as the judges pointed out, and as IEX I think pointed out,
Michael, I want you in the room.
all quotes have a delay being executed.
I am gonna put you in the corner so do not take yourself to the room.
Speed bump was structured as it was to mimic the geographic delay. It was to get rid of that essentially artificial delay, right? Exchanges could have put all of their matching engines in the same data center, and then they could have made it so that they were all faster than their fastest participants, and then you wouldn't have the opportunity for latency arbitrage, and you wouldn't have the opportunity for delays against quotes that are not immediately executable, or even having this debate. But they didn't, because that wouldn't have made them as much money, right? And so it just strikes me as absurd that not only are they trying to point at this as being artificially delayed, but they're not even addressing this idea that exchanges selling speed advantages to the fastest firms isn't the complete other side of that coin, right? The other side of that coin is that if an exchange facilitates some firms being faster than others, then they're putting a delay on those others, right? And they're doing so purposefully. And so there were so many, honestly, like I know the legal question is for you guys, for the lawyers, and I think that there's a lot here in this court case from a legal perspective that's probably fascinating. Obviously, my interest here is market structure, and I just thought that there were some serious bombshells that blew my mind in just that quick, whatever it was, 20, 25 minutes of a hearing, including Citadel acknowledging that there was latency arbitrage at least 10 or 12 years ago. People might see me make a big deal of the fact that the SEC in their brief acknowledged that there was latency arbitrage, and that Citadel just admitted that there was latency arbitrage. But I think what people here have to understand, who haven't been doing this for the last 10 years, is that when Flash Boys came out, and when IEX was formed, when Flash Boys came out, the whole point, the whole thing was about latency arbitrage. And the industry mobilized to say that was an absurd claim. Not just that it was wrong, but it was absurd. And they tried to gaslight those who were making the claim by saying, no, that didn't exist. Of course that doesn't exist. It's not actionable. It can't be done. And yet here, in the span of a couple of months, we've had the regulator come out and admit the existence of latency arbitrage and say that IEX proved that it existed. And we've just had Citadel come out and say that 10 to 12 years ago there was latency arbitrage. Of course, he's not going to say now there is, but it follows very simply from the things that he had said and the way that we're defining this, that of course there are still issues, that of course there are still firms that are faster than others. Ken Griffin said that, right? He said that recently, that the fastest firm wins. So even though, I think from a legal perspective, this case is probably, not as, impressive or controversial or even close, it seems, open and shut to me from a legal perspective. But from a market structure perspective, the things that are coming out and the debate that this is forcing again is getting us back to when Flash Boys first came out, back to this argument of what should market structure look like and why should it be that firms that are faster enjoy an advantage, and why is it okay for exchanges that are self-regulatory and quasi-governmental agencies to be selling speed advantages to certain firms and making it so that their drive to reduce latency is a profitable one. And why is Citadel coming out so strongly against an order type that simply prevents the execution of orders at stale prices? Because they admitted they want to execute against those stale prices. That's exactly what IEX said. That's IEX's point in the hearing. Citadel is sitting here and they're telling on themselves. And they're, it's not complicated.
public record right now, is that they're coming out and they're saying we need those scale prices. And then you start to ask the question of, well, why is Virtu not saying the same thing? Why is XTX, other high frequency trading firms, not saying the same thing? And I thought the point was made really well. I think it was the IEX lawyer who said that these are market makers. They're comfortable with these kinds of features because they help market makers and they hurt latency arbitrageurs. And to me, that's the crux of the market structure side of this. And I kind of can't communicate what a big deal this is, given the fights that have been had over the last 10 years around this exact debate. So it's really just fascinating and exciting to me.
Yeah, I agree with you, Dave, and Alex also really great points. And it's really, to me, it goes back to the idea that, when this was all going on and they initially filed this lawsuit, this was months and months before January. And, I feel like that Citadel didn't see this coming. They sort of, ran into a brick wall. They, for all the, like you said prior, Dave, what was the rationale in even, pursuing this? And then and that was before January, you would even ask that same question. But now with everything that's going on and all the awareness, to basically come out into open court and to make these statements, and to not only make them, but to be double downing and triple downing on them. I mean, they kept insisting, and the attorney stated at one point, there's nothing misleading about our assertion that we are here in support of the retail investor. I mean, I still can't understand how they can continuously make that assertion over and over again. I know they had nothing else to really say, but it's still bizarre that they said it in open court over and over again with 8,500 people listening plus. And then of course IEX mentioned specifically that this is a predatory tactic. This is predatory. This is an intentional methodology that they implement by purchasing this very expensive equipment so they can, get an edge upon everybody else and basically be a predator against the retail investor, not actually exchange on behalf of the retail investor. At one point, I was waiting for Chris Hansen to come in and take somebody away.
The Chris Hansen joke was bad. It was just bad timing. My phone close enough to unmute it. That was actually pretty funny.
I wish Twitter had a confetti emoji.
Right.
I was curious to hear everyone's thoughts on Citadel's argument in defense of their statements that they would represent retail investors. Obviously, I have my own, but I was curious to go around the table, see if anyone felt that they were persuasive.
Well, I mean, obviously, my views are probably clear, but I really I thought the judge's questioning at that moment was good, and I thought at the very least, in terms of the court case, it seemed to kind of expose at least where I think it was Raoul where she stood, which was that it's kind of difficult for you to make this case that you're trading on behalf of retail when such a high percentage of that volume is concentrated in the microseconds around price level change. And again, that's Citadel did make some very clear claims in terms of, they said they're not batching orders, and I believe them because I don't think they batch orders per se. I think that they execute those orders as they come in, but they batch the layoff, right? They were very clear about the language. She was very clear about the language that he was using. And Citadel, when it takes the other side of a trade, it doesn't have to lay off that trade or internalize it or lay it off immediately. No market maker does. This isn't Citadel. This is how market making works. You get exposure on one side or another. You build inventory. When your inventory risk gets too high, or when you think you're able to get out of that inventory risk, at a profit, you act. And so that's what I think is the underlying dynamic here, that they're trying to, like a magician, moving their hand quickly in one direction. They're trying to misdirect you to looking over there, while they're actually, doing something on the other side of it. And try and say that's the cause of a price change, but that's, come on. Retail is not sweeping the market.
It would have been only more absurd if they blamed it on like 5G and they said, well, the connections got so that's why this is happening. I mean, literally. As far as the questions, from the judges, I think even more so than Citadel's answers, I think the questions that were being asked are very telling of the mindset of the judges, and I think that's a good thing.
It is, and I think the precision of the language that Dave is pointing out, this is a universal maxim, but in corporate legal circles, there's pretty much a direct relationship between the billable hour rate and the preciseness of the language being used, because that precision is where you find the gray area. The precision of the language is how you can sit at a Senate hearing, for example, and say that you covered but you didn't close, right? Those are different concepts. Those are different things. So as long as you craft your language precisely enough, you can express a message that, while technically true, may not be the entire picture. One example of that I saw frequently being employed here by Citadel's counsel was the use of the term takers, right? Liquidity takers. They kept saying this is going to impair liquidity takers. This is an all liquidity maker rule. It's designed to just build additional liquidity on IEX, and it's purely for their profit incentive. But really, what's the truth of the matter is that the number of liquidity takers being impacted here has been quantified to at max 5. There were 5 proprietary trading firms that IEX had identified as being the primary participants during this very small signal window. So to say this is impacting liquidity takers is a very broad brush. It's a large.
Uh-oh. I don't know if it's just me. I think we're losing Alex.
Yeah, I can't hear.
He got Twitterized, but I know he was on the move, so hopefully he'll come back with a better signal.
Citadel themselves are.
I did like when the IEX lawyer made the point that blinking your eyes is 200 times longer than the IEX speed bump. I mean, this is, as someone who has operated at these speed tolerances and these latencies, it's hard to get people to understand. Like, it's hard for humans to understand what microseconds mean in real life. And that was a good way to kind of drive it home. But there was some discussion as to whether latency reduction has improved markets, and it's a point that I've sort of been making for a long time, is that I don't think there's any clear evidence that that latency reduction on the order of microseconds has improved markets, and especially has improved them materially so to offset the damage that is caused by the latency speed race. And, it's not really something that the court was going to get into, but it was sort of hinted at and talked around. And so again, to see some of these issues being elevated and reaching this level, I think is very encouraging. And hopefully this is just sort of the beginning of a real deep dialogue on it and some more market structure reforms.
In that regard, when they turned down dark fiber, which kind of plays into the bandwidth, how do you think that affected the efficiencies or use price discovery?
Yeah, I don't think that had anything. I don't think that had any impact, honestly. I just don't think that affected firms. Dark fiber is fiber that's not being used. These firms had no issues with that. A lot of them send signals wirelessly anyway at this point, because there's actually a speed difference. So a fiber optic line running in a straight line is still slower than a laser going from those same point A and point B, because the light inside a fiber optic line bounces off the sides of the line, and it introduces nanoseconds, maybe a microsecond of latency, whereas that doesn't occur on a laser. So these are the kind of tolerances we're talking about, and this is the kind of engineering that people are doing, to make more money in markets, not because it's making markets more efficient or improving execution quality, but because it's helping them win this race to pick off stale quotes.
I usually make bad jokes when I'm outraged, so the idea came to mind. Well, so basically this comes down to like guys buying laser pointers, if it's retail doing it anyway, guys buying, laser pointers at their local 7-Eleven, and that's how they're doing these exceptionally exorbitantly fast trades and causing all this problem, because it's surely not, the hedge funds or the market makers that are causing the issue. It's comical.
Right, yeah.
One thing I do want to point out that's not directly about the case itself, but just something that I find interesting, just as a lawyer, it's that the judges were very prepared today. They were asking, in my opinion, sharp questions. They really definitely took a lot of time to read the briefs and to know what was going on. And I bring that up because what drives me crazy is when they had those hearings in Congress, those members of Congress, they don't know how to ask questions. They never ask the right questions, and it frustrates me that most of these guys were actually lawyers at one point. But I always make the joke that a member of Congress couldn't litigate their way out of a paper bag. And I know it's frustrating, and I know it's slow, and because justice is slow, but I feel like with getting this stuff into the courts, is the way to get a lot of this out in the open. And I think today proved that a lot of things come to light through the judicial system, especially when you ask the right questions. And I think the lawyers were very prepared, and I think the judges were very prepared, and I think a lot of good questions were asked, and a lot of good information came out of this, and that's going to lead to a snowball effect and create even more questions that need to be asked. And I think this is important because it shows how important the other litigations are that are currently pending. And I wish that there was more open access to those courts in terms of virtual appearances, so we can listen in on the multi-district litigation in the short squeeze case that's going on in Florida against Citadel, and rather than we're sort of limited to only the papers that are filed. We don't get to really see any of the inside action and the oral arguments or any of those presentations, which is unfortunate because I think we would learn a lot more as retail investors, and I think that's why it's so important to stay informed and up to date with everything that's going on, because this is really about AMC and GME are very important, but this is really important about retail in general, right? Retail investors in general are being harmed by a lot of these rules and a lot of these circumstances that were not made aware of until a couple of months ago. And I think that we have to really focus our attention and really push members of Congress to get this stuff back on their radar and ask the right questions. We need the right questions asked. And Dave, I think you can piggyback off of that with me.
That's. I'm sorry. I honestly I do. I think this is. I've said it many times. I just think this is very exciting that people care, and that's the best part of all of this is that so many people care, and they're getting informed, and they're learning about markets and market structure, and they're discovering a lot of corruption and a lot of problems, and they're discovering people. There are a lot of people out there that are fighting it and trying to fix it, and so I think that I still kind of can't overstate how meaningful it is that some of the things that came out in this case, in this hearing, are things that were denied and laughed at for the last decade. And here it's not only coming out, but even the lawyer for one of the firms who would have been front and center for just belittling people who were making these arguments just admitted to them in court. cases, sort of winding their way through the system because one approach to fixing problems is in the private market, and that was what IEX wanted to do, was to build a private market solution and let competitive forces reward that solution or not. One approach is regulatory for better or different regulations and legislation, and then one approach is the judiciary, where you go through the court system when those other approaches fail, or when the private market is being prevented from realizing the best approach because of incumbents and corporate concentration of power. So, it's really for many years now been sort of a multi-pronged effort to try and improve markets in every way possible across each of those channels. And I think now we're starting to see, the timing is kind of fortuitous. We're starting to see all of that coming to light and happening, and so it's I'm excited to see it. It's really something.
Yeah, to lawyer Ames's point, apologies, I'm literally driving over the bridge as we speak. But to lawyer Ames's point on the information that's coming to light with this case, and eventually will come to light with the other pending cases, really subpoena power and discovery are very powerful tools. The vast majority of cases are pre-discovery still. They're winding their way through motions to dismiss, which is a process that parties have to survive, where they actually demonstrate that there's legal sufficiency on the facts that they allege, that a claim can be made if those facts alleged can be supported by the discovery process. So we are very early on, and it's excruciating long. I agree, but we are still very early on in the information discovery phase that not only will come out of the current litigation, but other expositions, other explorations of the same asset that's been generated out of all of this conduct. It will be very interesting to see how these cases move on. Once they enter the discovery phase, what measures are being taken to try to close the door and address by resisting that discovery, and what information comes out of it. So I think we are all in for an interesting 2022. And I know it's crazy to say that right now. It feels like January was just yesterday in some ways, but also 10 years prior. But I think as really this effort to empower retail investors carries on and really expands, 2022 is going to be a very interesting year, both from a practical market side as well as from developments in multifaceted legal cases.
Yeah, Alex, I mean, you definitely hit the nail on the head that the current litigation for the antitrust tranche and the negligence tranche against Robinhood, obviously we are at least a year away before really getting down into the real potential discovery. But if they can survive that motion to dismiss, particularly the one that's currently submitted, the antitrust action against Citadel, if they can survive that motion to dismiss, it's a really big first step. And I think that's really, the judicial system, even though it is slow, but it really is the gateway to a lot of information. And like you said, subpoena power and the ability to depose, it's going to make a big difference.
And I think, one of the things that's provided, or one of the things that us are working on, pretty big group, we're putting together, actually somebody already did a petition regarding PFOF. There's another older petition out there, and then there's going to be another petition that focuses on January. The older petition is about, market-wide manipulation. The PFOF one has gotten a ton of traction, which is awesome. And then the new one will be focusing on, looking for answers from Congress, regarding so formal. I think that's the next step, and I think that'll potentially help put pressure on to change things, and I think that's ultimately what's needed. I think over the last 10 months in this community, in the community that a lot of us have been involved in here on Twitter, we've seen frustration. People are frustrated, there's no doubt. I think that's more widespread than we even realize. I think that's evidenced by the fact that there were 8,500 people, as mentioned, listening to this live on the court's website, on the YouTube there, on the stream, with a whole bunch more people here, and people are going to listen to it for days. So the time is now as far as putting the pressure on, in my opinion, and I think the three petitions, and then subsequently, and the three petitions, there'll be tweets flying around probably by the end of this week, and then hopefully within a week after that, there'll be the letter templates out there to be able to write Congress people, committee members, media, the gamut, any place where we can, politely apply pressure towards, being heard and being recognized and getting something accomplished is the goal.
I just wanted to add to that. So about the letters, I just think it's good for everyone to consider how DC is split like right now. And just going by the retail numbers from votes, we even just in the US, obviously we'd be voting, but we easily have the number to swing seats. Like, there's no doubt you saw how close this whole debt ceiling thing was. And if we can organize as like a bipartisan group, because everything's super partisan in politics now, but if we get, in my opinion, the message across that us as retailers are willing to look past our partisan divide and vote in a bipartisan way for results, I think uniquely the way with how DC split right now, it would be the best time and best chance for us to write these types of letters to Congress. And if we're pretty consistent with it, and they realize that we're organized in terms of voting, not in terms of trading, but I don't know. I feel like they'll feel like they have something to answer to, especially with DC being split this close.
I think that's right, and I think that there are specific bills that can target. There are bills in the House to eliminate payment for order flow. So there's definitely a way to organize constructively here and to show Congress that there are numbers behind it, and that's exactly. Again, that's why I keep saying how great it is that people care now, because that's how change is going to happen.
Do you feel like, Dave, over the years when you've been arguing for this, you don't have like for a lack of a better term, just to clarify, like an army of angry retail investors behind you?
No.
Kind of like supporting you?
No, it's even worse than that, because look, this stuff is complicated and it doesn't, it's hard to penetrate into the jargon and the terminology and understanding how markets work. So it was never that surprising, but it was even worse than that because you had Citadel and TD Ameritrade and Schwab holding themselves out, and other brokers like that saying, "Oh, we're here and we represent retail," right? So it was even worse than retail not supporting the side that actually is fighting for them, but it was like you're being gaslit by the ones who make money, not when retail does well, but simply off the backs of them. And so I think that this sea change is so meaningful in that way.
And I don't want to speak for Dave, but from experience working with whistleblowers or agency level, SEC, HHS, it's living hell. Everyone romanticizes, well, maybe not everyone, that's an overstatement, but the idea of being a whistleblower is not this romantic thing where you get to escape with this piece of knowledge that helps the world writ large and reclaim for the government a fraud that would be conducted against it, which is why the whistleblowers receive such a tremendous percentage, usually between 15 to 30%, depending on the circumstances. Their lives are hell, typically during the litigation process, which for those cases will be 4 to 6 years. So
I have a question from someone for you. What do you think a market would look like with absolutely no payment for order flow, even if they were paid or not, but basically funneling your orders to a market maker?
Yeah, right. I think it's really important to draw the distinction that payment for order flow per se is not the fundamental problem. Payment for order flow is sort of part and parcel of inducements, order routing inducements that are based on execution quality. So that is an issue, but the fundamental problem is the ability to execute orders off exchange without material price improvement. So getting rid of payment for order flow will simply put more money in the hands of Virtu, Citadel, and other internalizers. But getting rid of off-exchange trading without material price improvement will really have a foundational effect on markets, and it'll make it so that those orders have to go to exchange. And there are varying estimates, but one of the compelling ones I've seen is that you would see spreads narrow by 25% or more. So what would happen as that order flow goes to exchange is you would start by seeing this compression of spread and a reduction of execution costs across the entire market. But I think over the long run, it would be far more sort of profound than that. Like execution quality and execution costs would continue to decline, but market quality would really improve because you would encourage a greater diversity in market making. And so you'd have more firms competing, right? This is just around the notion of competition is good. And in this context, I firmly believe it. So competition for order flow, you'd have thousands of firms, not just 4 or 3, competing for that order flow, competing to price improve those orders, provide midpoint executions. And so over time, markets become far more stable because the more diversity we have in market participants and in market making, the more stability you would have, the more consistent markets would operate. And so as a force for capitalism, the engine for capitalism, I think the benefits would reverberate throughout the entire economy. So, to me, this is a really important issue. It's not just about, a couple firms making money or not making money. It really drives the, sort of a foundational aspect of U.S. markets, and it's something that I think needs to be fixed and needs to be improved on. I don't know about everyone else, but it's been the whole morning for me. So I think this was great. I really enjoyed it. I'm glad we did this. It was again just awesome to see so many people join the stream and join us for this conversation. And I think this has been fascinating. And I can't wait to see the result and see what the court thinks about it all.
Yeah, I was just actually messing in the background regarding the QAs. There are a ton of questions that have come in, and I'm just thinking that instead of trying to triage or rapid fire, right now, maybe we're better off trying to set up a call for later this week. If you're willing to commit to that, to kind of digest the questions that have been asked in a more orderly fashion, just because I don't know that we'll do it justice right now. 2 hours and 12 minutes into this.
Yeah. I think that'd be fine.
All right. So as soon as we have those details worked out, I'll announce it. But I do appreciate all the questions, and I mean, I'm sure other people on this panel have gotten as many, if not more, than I have. But there's a ton of questions out there. We want to get to them properly.
Yeah, big thanks to Dave and Alexander and Lawyer Reeve, even though he's not in here.
Absolutely, yeah, he lost connection a couple minutes ago as well. So thank you, Dave. Thank you, Alex. Thank you, Citadel Air. Sam, who had trouble getting back in. Unusual Whales. Certainly TMI, who was stopped in and is actually broadcasting now, I believe. And I know I'm forgetting, obviously, you, Trade Tiger. And I know I'm forgetting somebody else, but I can't think of it.
You're forgetting to thank yourself, Dave.
That's thank you for my new phone not melting. I guess that'd be appropriate.
Yeah, thanks for organizing this. I enjoyed it.
Yeah, when Lawyer the Apes brought it as an idea, I was like, that's brilliant.
several platforms listening to this. So that's pretty big.
Yep. All right. Thank you guys all for coming in and helping out, and we'll reconvene shortly soon.
Happy
Great. Thanks, everyone.
And
thanks. Happy Monday.
Take care, guys.
Hi, baby. You are so beautiful. You're so pretty. You're so sexy. Oh no, I'm not the perfect one, not me. No, you're the perfect one. As perfect as you can be. So the boys have been staying. They've been in the room all day, unfortunately. Hold on, here. I think you kicked me out of my. I was streaming the court they were talking about. Oh yeah, you turned it off when you called me. Oh, sorry everybody. I know nobody's watching right now, but I'm sure people will be when they want to go look at it. Okay, that might have been it. Actually, let's see here. Oh yeah, nope, they're still going. All right, I gotta turn it back on for everybody to listen to. Sorry guys for the lapse in awareness and the lapse of coverage. Did not mean for that to happen. I'm trying to fix it now. Oh, I think the space ended actually. No recording. They didn't want anybody to record it, I don't think. But whatever, it's okay. Anyways, that's it, guys. I believe that's it for the stream. Let me know what you guys think, and if there's any other any questions, just please comment below. Thank you for watching, and peace out.